Good morning. We're getting ready to start, so if I could ask you all to take your seats. Good morning and welcome to the Fall 2024 UCLA Anderson Forecast Conference. We've got a great program today. I want to make a few introductory remarks and then we'll get right to it. And so first, for those of you who don't know me, I think most of you do, but I'm Jerry Nicholsberg. I'm the faculty director of the UCLA Anderson Forecast. And we have with us our crack forecast team. And the first part of our program is going to be a U.S. outlook, and that's going to be presented by our newest member of the forecast team, Clement Bohr. Clement has come to us from Northwestern University, and he leads our U.S. forecast team. I'm going to follow that with a California outlook. And then the third forecast presentation that we have today is on some new research that Thomas Ash has put together. Thomas is in his second year now with the forecast. His interests are in finance and climate change. So this is going to be a really interesting presentation. After that, we're going to take a short break, very short break. And then we have a really great keynote and a panel coming up. So a good program today. I think you're really going to enjoy that. So let me first start off by thanking UCLA Center for Impact, who is partnering with us on this. The Center for Impact is sponsoring, continues to sponsor research into climate change and business and what all that means and how we look forward into the future. Also want to thank Mercury Insurance. Mercury Insurance has generously sponsored our climate change economist, Ji-Yoon Lee, who is going to be on the panel. So that's in kind of the third part. So Ji-Yoon is the Mercury Insurance climate change economist at the forecast. And then finally, before we get started, as you all know, we're a public university, and we couldn't put on programs like this without the generous support of our sponsors. So I really do want to take some time to thank our sponsors. Our principal sponsors today are RSM and Yamava Resort and Casino at San Manuel. Our platinum sponsors are the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, Leap Development, PNC Bank, Robert Half, and United Airlines. At the silver level, Bank of California, Chevron, Comerica Wealth Management, JLL, SoCal Gas, U.S. Bank Private Wealth Management, and Wilmington Trust. At the bronze level is Hanmi Bank, HDR, and Shoma Design and Construction. And our Bruin level sponsors today are Gerber Kawasaki Wealth and Investment Management and Elphi Homes. Many thanks to them. And if your organization was not just read off, see us afterwards because we can fix that for the next conference. So with that, let me turn it over to Clement. And Clement, what's happening with the U.S. economy?
Well, thank you, Jerry. Good morning, everyone. So today, what we want to do for the U.S. economic outlook is take a step back and review some of the economic imbalances that are still with us after the COVID-19 pandemic and were really created in the aftermath of the COVID-19 pandemic. And then seeing how these imbalances are going to unwind over the next couple of years is going to tell us a lot about where the U.S. economy is headed. okay? This is also a great time to take a step back and just take stock of where we are for the US economy, because 2 weeks ago was a very pivotal moment for the US economy where the Federal Reserve decided to cut the interest rate by 50 basis points. This was really them signaling that they feel much more confident now about having inflation under control. So here I've just taken out a quote from Jerome Powell from their FOMC meeting, where he says that our patient approach over the past couple of years has paid dividends. Inflation is now much closer to our objective, and we've gained greater confidence that inflation is moving sustainably towards 2%. So why are they feeling so confident? Well, we can look at the Fed's dual mandate of full price stability and full employment. On the left plot here, I'm showing the quarterly CPI inflation rate. And what you can see there is that already a year ago, we had a rapid fall in inflation, and it was already touching down to the 3%. Then going into 2024, it had a slight dip up at a little bit of a scare, but since then it's fallen rapidly, and over the summer it's come down to the mid-twos. That has really given the Fed this confidence that they really have inflation under control. Now, turning to the unemployment rate, what you see also over the last couple of years is that we've had a very low unemployment rate. Now, why do I say it's very low? Well, what I've also plotted is a dashed line of the natural rate of unemployment, or the non-accelerating inflation rate of unemployment. This is the rate that the Fed estimates at which the economy is in balance and there aren't any excess inflationary pressures one way or the other. And what you see is that over the last couple of years, it's been far below that target, so to speak. But over the last year especially, we've seen a rapid rise in unemployment, still very low, that's approaching much closer to our target. Another thing I want to point out is that even though the Fed has gained this greater confidence, what you can see in our forecast, and this is also very this is very much aligned with the Federal Reserve's own projections, is that inflation isn't going to come fully down to 2% until 2026. So how can it be that the Fed has already gained this amount of confidence? Well, if you look at the inflation we have right now, almost all of the excess inflation we have comes from the cost of shelter, of housing and rental rates that people are signing in their leases, okay? Now, and that's what I've shown here. This is decomposing it, where the turquoise bars is what's making up the cost of shelter index. And the news is actually better than that, because all of the current inflation we have in this cost of shelter price index is actually due to previous inflationary pressures, right? So what I've plotted here on the right is, first of all, the turquoise line is the same inflation index for the cost of shelter that I've shown you on the left plot. But then the black line is the one for that was inflation for current market contracts, right? So the CPI index for the cost of shelter is not just what, if you go out and sign a new rental lease today, what rent you have to pay for that. It's the average of all people's current rental contracts. So it includes leases that were signed many years ago, and many of those leases have not been re-signed or have made up a markup to the current market rate of what, say if you want to sign a new lease or a new rental contract today. And what you see in the black line is that there was a huge amount of inflationary pressure for new market contracts during the pandemic, but that has returned to its pre-pandemic trend in 2023 and is staying very stable there. Yet the turquoise line is still above that because it's still playing a lot of catch up. There's still a lot of old contracts out there that are playing catch up and are being priced to market. So with that being said, where do we think interest rates are headed? The Fed just cut the interest rates by 50 basis points. And they have projected that there will be another 25 basis points cuts in the next two FOMC meetings. That's also what we project. So there's going to be another cut in November and another cut in December as well. Then, not quite aligned with what the Fed's own projections are, is that we're going to have a more gradual pace of rate cuts going into 2025 with an average of 25 basis points per quarter. And importantly, we actually believe that by the end of 2025, the Fed is going to pause interest rates cuts in the band between 3.25 and 3.5%. That's because we believe that when we get to that point, the economy is actually going to be going through a very strong period of economic growth, and the Fed is going to tamper the brakes with fear of overstimulating the economy any further. And so we don't believe that the federal funds rate is going to go as low in end of 2025 and 2026 as the Fed currently projects it will. Now, what does that mean for long-term interest rates? while long-term interest rates have already fallen by 1 to 2 percentage points, depending on what security you're looking at over the last half a year or so. But surprisingly, after the Fed announced 2 weeks ago that they cut the short rates by 50 basis points, as well as a more aggressive schedule for monetary easing going forward, long-term rates actually went up. Okay, so what the Fed really signaled and what the financial markets really gathered is that they have much more confidence now that we have a lot of strong growth going forward, and the probability of a soft landing has greatly increased. Okay. And so with that, we don't expect long-term rates to fall much more than where they are now. And then actually in the mid-2025, 2026, we're going to have a slight bounce back in long-term rates. Here I've plotted a 10-year treasury that's going to go up to 3.9%. And that's going to come from that revision in the short-term rate expectations, because they're going to be paused at that higher 3.25, 3.5%. And so the term rates are going to have to readjust their expectations for the short-term rates are going to go in mid-2025, leading to a slight bounce up in that. That leads us to our headline growth projection numbers. This past third quarter we just had, we don't have the official numbers yet, but it's looking like it was a very strong quarter for GDP growth. And we have that from the monthly data on retail sales, personal consumption expenditures, as well as high numbers for industrial production and durable goods orders. Then in the fourth quarter, we're expecting more tepid growth, some near-term headwinds, which I'll discuss in a second. And then going into 2025 and 2026, we're going to feature 2 years that are on average going to grow at a very robust pace of about 2.5%. So we see quite strong growth going forward for the US economy. Now, what these near-term headwinds are that we are going into the fourth quarter are, first of all, 2 different strikes. The Boeing strike started about 2 weeks ago, and there's still not much sign of it letting up. A larger strike that just started this morning is the strike by East Coast dock workers, which closed down all the shipping ports on the eastern Gulf Coast. If this persists for a long time, this could be very damaging for the US economy. And then we also have another thing we haven't written up here, which is the impact of Hurricane Helene. When we formally finalized this forecast, Hurricane Helene hadn't hit the coast of Florida yet. And so it was unclear how large a toll that was going to be. And it's still somewhat unclear, although it's looking like it's caused a lot of damage, especially in places like North Carolina. And lastly, we have the presidential election. And when you have these big moments in democratic governments, there's usually a lot of uncertainty associated with those. And there's definitely is this year for the US, because this election is such a toss-up. And the way businesses respond to that is that they tamper their investment. They just defer their investment for a little bit as they wait and see to see how the election pans out. So with that being said, going into 2025, we're going to assume for the rest of the forecast that all of these headwinds are actually going to resolve themselves quite smoothly through the fourth quarter of 2025. Right? And on top of that, because this presidential election is such a toss-up, we're certainly not going to make a prediction about who wins the White House or the Senate or the House of Congress. And instead, we're going to assume that there is continued gridlock going forward. So we're not going to make any predictions about any new policies one way or the other. And so for the rest of this talk, what I'd like to go over are some of these lingering economic imbalances that have been with us since the pandemic recovery, and see how these are going to unwind over time. And these include the housing market, the auto market, and household expenditures. And it's really worth noting just how wild a ride the housing market has been on since the beginning of the pandemic. We started off very strongly with this shift to remote work, which greatly increased the demand for housing and space as people suddenly weren't constrained by their commuting zones or just wanted more space because they now had to work from home all the time. That was then amplified by very aggressive monetary policy, where the Fed cut rates to the zero lower bound, which led to historically low mortgage rates, which hit down at 2.8% at one point. And then after that, we had this whiplash in interest rates where the Fed aggressively raised them by 5 percentage points, which led to a similar whiplash in the mortgage rate market, which reached up into the mid sevens. Right? And now we're finally seeing mortgage rates coming down a bit again. So these first 2 points led to a huge boom in the housing market in the early part of the pandemic, which I'm sure we all remember. And what I want to focus on here is the effects of this whiplash, of this sharp rise in mortgage rates that occurred when the Fed decided to tighten monetary policy. So what I'm showing you here on the left graph is the gray line is the average mortgage rate of current homeowners of all the mortgages that are currently in the US economy. So it includes mortgages that were signed, say, 5 or 10 years ago that are still being paid back. And the black line, we have the average mortgage rate for a new contract that are going to be signed today, right? And so what you see is that for most of the past 20 years, 30 years, the average mortgage rate has been slightly higher than the current market rate because there's been this downward trend. But then we had this sharp reversal where the market rate for a new mortgage actually increased to where there was a more than 3 percentage point gap between what a new mortgage would cost you relative to what the average mortgage of homeowners have. And so in general, when this happens for an individual household, this is called golden handcuffs because, you know, a person or a family may need to move because they have gotten an extra kid and need another bedroom for this, or they've moved jobs and want to be closer to their new job. But if they have a mortgage rate that's much lower than what they would get if they have to move and get a new contract, they're not going to want to move. And so they're really constrained. And that's why we have this term golden handcuffs. And what this mortgage whiplash did is that it created this concept essentially for the whole economy, right? It was really extreme where we see that in the past, the green, so this graph shows you the share of existing homeowners that have mortgage rates above or below the current market for a new mortgage contract, with the green being the share that has a rate above, and the purple ones, depending on the intensity of the color, below. And what you see is that what happened in 2022, 2023, is that we now are in the situation where nearly the entire housing market, everybody that has mortgages, has an interest rate that's much below what the new market rate is. And so that completely froze the housing market and led to a complete collapse in existing home sales. Okay, so on the left plot here, I'm showing you the existing home sales since 2008. You also very clearly see the boom in housing sales in the beginning of the pandemic, but then we fell off this cliff, all right? And this cliff was so extreme that it actually led to existing home sales to be at a similar level that they were in the Great Recession. So these are really extremely low levels of housing sales, right? Now, with that being said, mortgage rates are coming down now. At the same time, hybrid work seems to very much be with us, at least for a long time going forward, with occupancy rates stabilizing around 50% in the office market. And we also have a large, or actually the largest segment of the US population, millennials in their early 30s, that are entering the prime home buying years. So what we forecast, because of all these convergent disparate factors, is a large rebound in residential investment, with home sales going up as the golden handcuffs slowly come off and all this new demand for housing comes in. And with that rise in existing home sales, we also have a rebound in new house starts that are going to gradually recover to where they were before the pandemic of about 1.6 million annually. It is worth saying that for new housing starts, I'm only plotting back to 2008. If you go further back in time to the 1990s, those levels were actually above the 1.6 million. So we're still in this long period of underbuilding where we're not building enough relative to what demand there is. Next, I want to go to the vehicles market. For the vehicle sales, one thing that was very notable about the pandemic is that we had this large dip in it through 2022. This was the supply chain shortages, the lack of microchips, and the lack of inventories in vehicles. And then after that recovered in 2023, what you see is that the vehicle sales numbers actually never recovered to where they had stabilized before the pandemic. Okay? And so why is that the case? Well, one part of that is that the vehicle market right now is going through a transition from combustion engine to hybrid and electric vehicles. Engaging that transition as a producer is very difficult. And it appears that they've been a bit optimistic based on the fact that they produce a lot of EVs, and these have been building up with car dealers having a large inventories of electric vehicles that haven't been sold. Another large part of this is the rapid increase in vehicle prices we had during the pandemic that has not come down very much. So the price index here was actually normalized back to 1997, which means that over the last 20 to 30 years, the price of a new car hasn't changed much, okay? Quality adjusted. That's even more stark when you consider the fact that on average, the price level has risen by 2% a year, right? So actually, in real terms, prices for cars have gotten cheaper over time. And then the pandemic hit, and we had this huge surge in the price of cars by almost 30%, and has not come down, even though the market otherwise has normalized some. And so this is why we have this suppressed level of sales right now for cars, is because the prices are still out of balance and prices have become very sticky going downwards, and it's going to take another couple of years for them to fully adjust. And so during this adjustment period, we see this gradual recovery in vehicle sales, although by 2026, still not quite up to the above 17 million units a year. And lastly, I want to go over the households' expenditures and their balance sheets. So another effect that the pandemic had is that it shifted households' expenditures away from services and over to goods, where we just, sometimes by mandate, but also by choice, just did not go out and spend at restaurants and the movies and so forth, and decided to buy, new cars and new furniture and the likes. And what I'm showing here on the left plot is this consumption in real terms of durable goods. So since the beginning of the pandemic, the consumption of services and expenditures in services has recovered to their pre-pandemic trend, okay? But what you see here is that the durable consumption that we have is still very elevated with very little sign of reversion to its level that it was at before the pandemic, okay? This means that we now, since 2022, households have been spending a lot more than what they were before the pandemic. And so how have they been financing the spending? Well, early on, they had a lot of pandemic savings because they couldn't spend it, and also because of the fiscal stimulus we had. But as that wound out in 2022, and the saving, what you see is that the savings rates actually declined down to 3% or so. So households were really then just saving a lot less and taking on a lot more debt and credit to finance this larger levels of expenditures. In our forecast, we don't have this changing very much going forward. The durable levels, the consumption levels in durables is still very elevated. And because of the surge in residential investment that we're forecasting from the rebound in the housing market, there's a lot of durable expenditures that goes along with that too. So we don't see any reason why there's going to be a rapid reversion in durable goods consumption. And this is going to mean that we're still going to have elevated level of consumption expenditures going forward. That being said, you do see a slight gradual reversion in 2026 towards more sustainable savings rates, because we cannot go and spend at this level forever. Right now, the balance sheets of households are still looking good, but we cannot stay at this level forever. Yeah. So to conclude, both inflation and unemployment are near the Fed's target, which is why they've started monetary easing. And when I say monetary easing, they're just going to a more neutral level. It's not that they're actually trying to expand the economy. The U.S. economy maintained a fast pace of GDP growth here in the previous third quarter of 2024. We expect a temporary slowdown in the fourth quarter of 2024. And then going forward, we predict fairly robust growth for the next couple of years from a rebound in the housing market. Thank you.
Thank you, Clement. And one thing that occurred to me while you were talking was that the fact that us boomers are not putting our houses on the market to sell to you millennials is good for the economy. So now I feel better about that. So we're going to talk about the California outlook and continuing this theme of growth, but also adjustment. And I've got some images up here of things that I want to talk about, and sort of starting in the upper left-hand side is housing, Silicon Valley. We've heard a lot about the layoffs. Hollywood and education. And so to do that, our roadmap for today, we're going to look at GDP across states, comparing California to what else is happening in the US. This is a political season, so we're hearing a lot of things about California, and many of them are comparing California to what happened in the Rust Belt, right? Everyone is leaving, and so on. So we really want to look at data, see what is happening, where the weaknesses are, what the implication of that is for the outlook for California in the next couple of years. So we're going to do that by looking at various sectors, and then we'll turn to the outlook. So first, just looking at GDP, and I want you to look at the left-hand chart here, and that one is growth from pre-pandemic to post-pandemic. So it's 2019 quarter one to 2023 quarter one. And what you see here are the growth rates of the large states. So there are 23 states that have population over 5 million. The other states are so small that they don't really impact GDP. So for example, if Delaware were to grow at 10%, which would be outstanding, you'd never see it in the GDP numbers. So these are the ones that matter for GDP. And you see the usual suspects are here. We have Arizona, Florida, Texas. In gold is California. All the way on the right is the US. So California is indeed growing faster than the US. And on the right is the last 12 months through the second quarter of 2024, which is the latest data that we have. And California has moved to the left, still growing faster than the US. Some have moved to the right, such as Texas. Georgia and Wisconsin have actually come into play here, which may have political implications. I'm not a political scientist, so I'm not making a prediction, but this is the change that we've seen over the last year. Now, there are two ways that you can get an increase in GDP. One is to have more people, and we've had a lot of migration over this period. More people doing stuff, producing goods and services increases GDP. And this is why China has the second largest GDP in the world, but is still a relatively poor country. And that's because they have 1.4 billion people doing things, right? And so we want to adjust for migration because some of these states have had really significant migration. We're going to do that by looking at per capita change in GDP, right? So adjusting for migration, when we do that, we find, as you see in the graph that's on the left-hand side, California is the fastest growing state. Now, why is that? The reason for that is that we have productivity increases, and we actually have a churn in California that's been happening for some time. And that is that folks with large families, particularly if they don't have a lot of education and don't have a lot of earning power, find living in coastal California is difficult. And they can get a better life elsewhere. When they do that, they're freeing up housing for folks who have more income, more earning power. But those who are moving in and taking those housing units have higher education, therefore higher productivity, and that's where you get this growth. So if we looked at manufacturing productivity, for example, in North Carolina, we would find that it is negative. And it's not because North Carolinians in the factories are sitting there on their phones where they weren't before. It's that the kinds of industries that are growing in North Carolina have low productivity activities on the part of their labor force. And in California, we're moving to higher productivity. You're going to see this a little later. But we do have some concern here. 2024, California was not growing faster than the US in the last quarter. 2.8% versus 3% is kind of within statistical error, but that is a change from what we were seeing before. We also saw this at the end of 2023. And so we want to look to where we have weaknesses in California and try and interpret that in terms of the forecast. And so the first place that we're going to look is what's happening in employment. Now you see two lines here, a blue line and a red line. The blue line is labeled total employment. That comes from a survey called the Household Survey. It is a survey done by the Bureau of Labor Statistics that measures whether or not people are employed based on their domicile, based on where they live. It's a small survey. For California with 40 million people, it's only 5,500 respondents. And that's where we get our unemployment numbers. And California's unemployment is very much elevated relative to the US. And if you notice on the blue line, it never kind of comes back to pre-pandemic peak. The red line is a much more reliable survey because it's a much larger survey. It's the enterprise survey. It measures jobs where people are employed. So these are payroll employees. But it's worth talking about what's in one and not in the other. And so in payroll, the red line, but not in total, are remote workers who are living out of state. So if someone's living in Phoenix and working in San Francisco, they're in the red line, right? Because they are payroll employees, but they're not in the blue line because they're counted as part of the Arizona workforce. And so they're not counted. And so that's maybe one of the reasons why that's not coming back to pre-pandemic peaks. The other is undocumented workers who have documents that allow them to work, but they're fake documents. So their employers are reporting them as payroll employees. But when the Bureau of Labor Statistics calls up, if they can find them, calls up and says, are you employed? Most likely they're going to say, no, not employed, right? So, so they're not going to be in the blue line. In the blue line, but not in the red. And one of the reasons, and really the principal reasons why that is above the red line, above payroll employees, are farm workers. And because of the winters that we've had, you know, we have fewer farm workers. And you see that with the destruction of farmland as you're driving north through the valley and, you know, looking at Tulare Lake, right? A second is independent contractors, 1099s. And so that's going to be important later on. And then we have family workers in family businesses. Think of family restaurants that have closed because of the pandemic, and gig workers. So that's kind of the differences that we see between the number of jobs that are reported, that's the red line, and the unemployment rate, which is the blue line. So let's dig into this and look at where we've lost jobs, where this weakness is. So this is job loss by sector, and I'm going to color code that. And so this is a scientific and technical consulting. So that's tech. This is Hollywood. This one is real estate, so brokers. And then we have software publishers, so more tech. Credit intermediation, which is at least in part related to those housing markets that we talked about. Scientific research, which is in tech. And then employment services, this is temps. And one of the things about temp workers is in good housing markets, you get a decline in, not good housing markets, good labor markets, you get a decline in temp workers, because temp workers in good labor markets are hired as payroll employees. And then we have non-durable goods manufacturing, a long-term secular trend to fewer people working in this sector, not just California, this is nationwide. These are things like paper and plastics and so on. And then finally, computer and electronics manufacturing. We're going to look at that one, that big one first. So turning to that, this is output in manufacturing in California from 2018 to present, to the latest data we have. And if you go here to last year, we were up by 21%. Now you see the next two are lower. That's that decline that we just saw in that red block. But that still puts us 14% above where we were in 2018. The question is it going to continue to decline? And our answer is no. And I want to show you some anecdotal evidence as to why. And that is, we have factories being built all over California, and this is just a sampling of them. But if you start in the upper right-hand side, we have Tesla building a large energy storage factory in Lathrop. And obviously Tesla knows a lot about Nevada and a lot about Texas. They have big factories there, and they're building this one in California. And you come down, so we're going clockwise, Scorpios, moving from Texas to Temecula, and that's semiconductors. And now I'm going to jump around. Bosch and Roseville Semiconductors, Evercharge and Hayward EV charging stations. These are going to be adding jobs in that sector, that subsector that was losing jobs in that last graph. And then we have aircraft production out in the high desert here. And what may surprise you, in Mojave, we're getting our next steel plant, right? So manufacturing is increasing in California. We have it increasing in our forecast, not at a really rapid rate, but these factories and others are going to be opening up in 2025 and 2026. Now turning to tech, there is no tech sector, so we have to infer from tech intensive sectors. And the red line here is professional, scientific, and technical services. And you can see it's increasing, it dips during the lockdown, it gets to a peak. Now you have the layoffs, and these are the layoffs like Google and Twitter and so on, but it doesn't continue. That's just a restructuring of these large mature companies, and you can see it's relatively flat. Another one that we want to look at is computer. And so this is computer design and the like, and you have a similar pattern. And we're not really concerned about tech. In fact, we think tech employment is going to increase because of all the new technologies that are being demanded, including AI. No one wants to be left behind with AI. And if you want to be on the cutting edge, there's only one place really in the world that you need to be. You might want to be in some other places as well, but you need to be in San Francisco. And so we're seeing money coming in and hiring coming in into San Francisco and the Bay Area. Now turning to housing markets, and as Clement was saying for the US, in California, new existing single-family home sales are at depression levels. That's the upper left-hand graph. And you just move your eyes from where the end of that red arrow all the way back across. And what you see is it's low and it is not really changing. Going down to the next graph, that's home prices. They've retreated. This is median home prices. They've retreated a little bit in California, but still, very high relative to history. And in the coastal cities, what we see from the Case-Shiller index, so the median home price has some compositional effects. It depends on what was sold. But the Case-Shiller, which lags behind this a little bit, is not showing this retreat in home prices. So higher home prices, not much existing inventory, means the builders should be able to make their business plan and an expansion in home production in California, particularly with the new laws that we have in California that make it easier, not easy, but easier to develop real estate in the state. The remaining graph there is permits for new home construction. And you see a couple of dips on the right-hand side, which are just weather dips in the winter, but we still really haven't come back to kind of the previous peaks, much less growth from there. So in the forecast, we've got a slow increase in housing production all the way through the end of the forecast, but the fundamentals are there for a lot of new home construction. One of the pieces of good news in terms of construction, because we know that office construction has slowed down to a crawl, is in retail. So this is the Alan Matkins UCLA Anderson Forecast commercial real estate survey. We do this twice a year. And what you see on the horizontal are the 8 markets that we survey. And on the vertical is a scale that goes from 0 to 100. 50, where that dashed black line is the dividing line. Above that represents optimism for vacancies and rental rates over the next 3 years, the things that go into the business plan, right? And so this is for retail. If it's below the black line is pessimism. And just starting from the left-hand side, San Francisco, still very pessimistic, and that's because you still have a lot of remote work and Asian tourists haven't come back to San Francisco, right? But as you come across, what you notice is everywhere else in California, there's optimism about retail, and we've seen the beginnings of a turn in the construction of new retail. The other thing to note is how long it took. So each block represents half a year of how long it took for retail to recover from this excess amount of capacity. And that gives you some insight or some hint as to what's going to happen with office, 4 to 5 years. Now I want to turn to Hollywood. We now have some additional data. And so this is a graph that I showed you before. And what we have here are days of filming in Los Angeles. The top line is television and streaming, and the bottom line is feature films. That big yellow block, that's COVID. And then the gray is the dual strikes. Now, what happens with strikes, and you'll notice that this is in fact happening with the East Coast and Gulf Coast dock workers, is that they're not unanticipated events. They're not surprises. So firms stockpile in anticipation of the strike. That's important. And if you look at the studies, the economic studies of strikes through the years in the US, you see this happens again and again and again. And that's important for this because if you look at the top line, you come out of COVID, there's some catch up, and then it just starts declining rapidly. All the way into the strike, there's no buildup in anticipation of the strike. You come through the strike, and the 3 quarters after the strike, it seems to have stabilized. It might still go down some, it might still go up some. But what this is telling us is that the purchasers of content were purchasing too much content. And anecdotally, we know that. And so they've cut back, and they've cut back dramatically. And what this means for employment and growth in California is that there are a large number of workers in Hollywood that aren't going to find jobs in Hollywood anytime soon. And they're going to need to move into other sectors. And importantly, a lot of those jobs are by independent contractors, right? And so those are in the blue line, those are in unemployment, they're not in the red line, which was payroll jobs, right? So if we do just we don't know how many people this is, but if we kind of do a ROM estimate, this has probably 0.3 to 0.4% differential between California's unemployment rate and the US. So it closes the gap actually quite a bit. The bottom is feature films. It is lower, but it's not a lot lower on a percentage basis, suggesting this really is in television and streaming. Other sectors of concern that we have, initially I talked about this churn in California and smaller families. We know that because in K-12 education, that's the left-hand graph, we have a decline in enrollment. We've got schools that are closing, and this is not coming back, which means there are folks in that sector, particularly support roles, who are going to have to move into other sectors. That's part of the unemployment. And then gig workers who have been engaged in delivery services, that is also shrinking now that we have some distance from the pandemic. The higher minimum wage is pushing more people out of that. And there's a picture here of Pizza Hut that fired 2,000 delivery workers because of the higher minimum wage. And they said, you can use other delivery services, but basically delivery services are shrinking. So kind of couriers, Hollywood, education support, those are sectors where we're generating this higher unemployment. And that's going to stay for a while. But so just to bring this to a conclusion, manufacturing and tech recovering in 2025 and 2026, construction, real estate, and agriculture. We also expect a recovery, but more slowly. Hollywood, education, and couriers, as we just said, that's going to take a while. And so that's going to keep our unemployment rate elevated through our forecast. 2024, atypical in terms of GDP. It's going to be lower than the US growth rate, not by much, but lower. And then returning to faster growth as we move forward, particularly driven by technology and advanced manufacturing. We have the usual risks to the forecast: housing and homelessness, urban public safety, drought and deluge. And finally, and this is kind of an important one, if we get a shutdown in China trade, that will adversely affect California, both because of supply chains and because of our ports. And there's been talk about that in the political campaign. Hard to see that that's going to come to pass, but it's a risk to keep in mind. So just to finish up with a few numbers, by the time we get to the end of 2026, we're really back to about 2019 kinds of growth rates. You see the unemployment rate of 4.4%, above the US for the reasons that we just discussed, and housing getting up to 127,000 units per year. That's good. It's more than 105,000 this year. It won't make a dent in affordability, though. It's really still too small. And with that, let me conclude and say thank you. And now we're going to turn to Thomas, who's going to talk about monetary policy, which you heard about from Clement, and its impact on green bonds and the environment.
Yeah, thanks, Jerry. So this is supposed to be a bit of a bridge between the kind of economic stuff we've been discussing and the climate change related material. So what better way to do that than talk about green finance? And so some people talk about climate change and monetary policy and say that monetary policy really doesn't have much relevance for climate change. So I'm going to try today to just indicate one way in which monetary policy might actually be of interest for climate change. So just to quickly start out, I just wanted to have a few slides mentioning something that I don't think is any new information, but climate change is getting worse based on a bunch of kind of observable metrics. So what we have here is just daily sea surface temperatures on the left-hand axis. And this just plots a line for each year since 1979. So this goes from January to December for each line. And what you can see is that some of the more recent years have been at the top of this collection of gray lines. And so what that means is that the temperatures that we see throughout the entire year are getting higher and higher. So you can see 2016 is basically sitting on top of this kind of gray mess. 2023 even higher still. And then you can see just peeking in on the left-hand side, that's 2024, which is even higher. So this is not too surprising, but basically temperatures are increasing a lot, and it's kind of shocking to see just how much in this kind of chart. And so in a way, temperatures can be a bit abstract. So it's useful to think about it in terms of disasters too, especially in terms of the US. So one thing that we can do is we can look at the National Oceanographic and Atmospheric Administration, who collect this billion-dollar disaster database. And so what they do is basically count the number of disasters that accumulate more than $1 billion of damage. And so that's kind of what you can just see in this table here. It's counted by decades. So you can see at the top in the 1980s, the number of billion-dollar disasters was around 33. And then what you see in the decades following is that this really ramps up to quite a shocking degree. And by the 2010s, it's around 131. And so if you also then compare that with the last 5 years, so that's not even a full decade, it goes up to 102, which is more than half of what happened in the 2010s. So this really seems to be ramping up. And the other nice thing that NOAA do is they put together these nice little charts for each year, which show you kind of where these billion-dollar disasters are happening. This chart only goes to July, so it's not going to include all the wildfire stuff that's going to happen in the West. It's not going to include some of the hurricanes like Hurricane Helene, which we now know is almost certain to be more than $1 billion, so it will be one of these dots. And I think one of the things that's quite striking about this is if you compare it to the 1980s, that decade, which had 33, well, a decade is obviously 10 years. So if we just divide that by 10, that's on average about $3 billion disasters per year. So that means if we looked at this for 1980, there would only be 3 dots for the entire year here. Whereas you can see already by July, there's already a huge number. So climate change seems to be getting worse. And I know that's kind of a depressing way to start this, but it's going to get more optimistic, I promise. But what this really means is that we need more tools. And for example, Olivier Blanchard, who's the previous head of the IMF, he has an academic paper where he talks about all the different tools we need and argues that we need a range of tools to combat these climate change issues. So one way that we can talk about this, or one tool, is these green corporate bonds. And so that's what I'm going to talk about for the rest of this talk. And so just as a bit of a refresher, corporate bonds are basically when a company has a range of investment projects and they want to do them, so they need to get financing to be able to do those. And so what they do is they package those investment projects together. They come up with a nice glossy leaflet called a prospectus that describes those projects, and they lump it together into this bond, and then they sell the bond. And then the cost of the bond is basically the investment money they get. So it's essentially a form of borrowing. So that gives them the money. And then they agree after a set maturity period to pay that total amount back. So they essentially buy back the bond. And in addition to that, they agree to pay a coupon each year. And the coupon is essentially like the interest payment, right? And so then if you take that coupon and you divide it by the total issuance amount of the bond, that's called the yield of the bond, which is just kind of another word to say the interest rate. So if the bond's yield is higher, that just means that the cost of borrowing for these companies is higher, right? So we're going to focus on these kind of yields later in the presentation. So what have I done? I spend kind of a lot of time, probably too much time, looking at these corporate green bonds. And so I've gone and just collected this universe of these corporate green bonds from the 2013 to present. And really, this is kind of the whole universe of these because they didn't exist really before 2013. And so when I talk about corporate green bonds, these are where the investment projects that the companies are interested in are to finance various green-related projects. So they might be renewable energy projects, they might be transition projects that companies use to try and improve their carbon dioxide emissions, okay? So in general, some of the characteristics of this universe of corporate green bonds, they're usually around kind of a 5-year maturity. This is a global data set, so these are being issued all around the world. A lot of them are in the US and Europe, and there's actually quite a lot in China too. But it's global, so they're in all kinds of countries. And generally, they're a bit higher rated than your average corporate bond. And then, so what I'm going to do is I'm going to match that with this data set of non-green bonds, which is kind of a typical thing to do so that we can compare them. And I'm going to match these on this set of standard kind of bond characteristics, like maturity, rating, issue date, and issuer, etc. And so that is going to allow me to make comparisons between these two. And then I'm going to be interested in monetary policy, like I said. And the main way that I'm going to look at monetary policy in this presentation today is to just focus on this most recent Fed fund rate rise that happened in March 2022. As most people probably know, it rose around 5 percentage points. And there was some forward guidance in around January 2022 that this was going to happen. So that just means that the Fed started talking about these rate rises in January 2022. So that's when the effect might have started, even if the rates hadn't actually started going up at that point. Okay. And so then I'm going to ask this question: how does monetary policy affect each of these bond groups? So just a quick note on why we care about these green bonds and why it's useful for climate change. Well, so this is just a chart showing investment needs for a range of different net zero scenarios, right? And so if you just look on the left-hand axis, that's $1 billion, and it just shows the amount of investment. This first column is just for 2021. So that's the total amount of investment to reach these net zero targets in 2021. And what you can see is it's just about reaching not quite 1 trillion, it's about $755 billion. And it kind of breaks it down by the different types of investment that are being undertaken. And so then we can compare that with the scenarios for 2022 to 2025. This is a bit of an old chart, so obviously some of this has already happened. But the 1, 2, and 3 at the bottom are basically just different scenarios of achieving net zero. And what you can see is the line just traces kind of the average, but it's a big step up. And this is really a big step up in investment funds for such a short period of time. It goes from being below 1 trillion to being above 2 trillion. So that's quite significant. And if you look at the scenarios out to 2026 to 2030, it's even more. So it's going up to above 4 trillion. So these are really sizable increase in investment. And the main point of this chart is just to say that someone has to finance this. We have to find ways of financing this, whether it's governments, whether it's private companies. And so this is where green corporate bonds come in, because they're a way of providing these kind of investment funds. And it's worth noting that these are really just for climate change mitigation. They don't include adaptation, which is going to be necessary too, so that we can like build seawalls or various other things that protect us from natural disasters. So there's a lot of investment need out there. So what's the optimistic thing? Well, the optimistic thing is that these green bonds have been kind of rising to the occasion in providing a lot of these necessary investment funds to kind of get that big shortfall in investment. What you can see here on the left-hand side is basically total monthly issuance in billion US dollars. And so each of these represents a month. And so you can see over in 2013, basically it was at 0. These didn't exist before 2013, more or less. And then this kind of steadily ramped up through to 2020. And then there was this enormous jump in 2020 to this kind of peak level of about 35 billion US dollars. And then after that, this is kind of relevant for this talk because around 2022, that's when this monetary policy tightening started. And you can see there's a bit of a dip, but it sort of stabilizes. And it's not like it goes back down to, back down to these levels we saw before 2020. So the point is that these green corporate bonds have grown rapidly. They're still not massive compared to overall corporate bonds. They make up about 4% of the global corporate bond market, but there's still a sizable amount of money that's useful for that investment challenge that I mentioned in the previous chart. So then just thinking about monetary policy, why do we care about monetary policy related to this? Well, this is just kind of a standard chart from macroeconomics that basically just says that interest rates affect investment, right? So on the left-hand side, I have this blue dashed line, which is just gross private domestic investment. And you can see that kind of varies from this period from 2009 to 2024. And then on the right-hand axis, we have this orange line, which is just the Fed funds rate. And so you can see that there are periods where the Fed funds rate is higher. That means interest rates in the economy are higher in general. And that generally makes it harder to invest because investment becomes more expensive. So you can kind of see that there are a fair number of periods where investment has dropped in those periods where the rate is higher. So that matters for this green investment challenge, if you like, because if these interest rates are higher, that's going to make it harder, or in theory, it would make it harder to raise these green investment funds that we need so much. And so that's the question I'm going to ask. Is this monetary policy in the same way that it is for economy-wide investment, is that also important for this green investment with these green corporate bonds? So that's what I'm just going to look at for the remainder of this talk. And like I said, the way I'm going to do this, there are quite a few ways in the research literature that you can kind of tackle understanding the impact of monetary policy on these things. The way I'm going to focus on today in this talk is just looking at this most recent rate rise and trying to understand how that affected investment with these green corporate bonds. So how can we do that? Well, in finance, we have this kind of methodology that's called an event study. Really, it's just kind of fancy statistical jargon for looking at what happened before and after an event that changed. So here I'm just going to look at before and after this big increase in the Fed funds rate and economy-wide interest rates. So what's this going to look like? Well, you're going to have a chart like this. On the left-hand side, I'm going to have my coefficient of interest, but really that's just measuring bond yields. So remember, yields were basically this interest rate for these green corporate bonds, and that's just a measure of that. If it goes up, then green investment is kind of more expensive. If it goes down, green investment is less expensive. And so we're just going to compare it before and after this zero period. On the bottom, basically, we just have months before and after the monetary policy tightening. So I go from around 20 months before the monetary policy tightening to around 20 months after. And I'm just showing you here how the Fed funds rate changed over this period. And you can see at the zero, it takes a little bit of time for it to start going up. That's because of that forward guidance I mentioned, where the Fed started announcing that this is something they were thinking about. So how does this look? So this is the chart for the non-green corporate bonds. And the way you should think about this is that for each of these columns, there's a whole array of different corporate bonds that were issued in that month. So each of these little bars is going to represent 1 month. And so there's going to be a whole bunch of dots you could imagine behind this that represent each corporate bond. And so what the dot is going to represent is basically the average coefficient. So you can think about it as being kind of like the average corporate bond that's issued during that time. And then the range you have, the line represents the 95% confidence interval. So it's kind of a measure of dispersion over the range of different corporate bonds we have. Okay. And so what we're especially going to be interested in is if this confidence interval includes zero, because if it includes zero, that just means it's not statistically different from zero. And what you can see from the period before the monetary policy tightening is that most of these dots include zero still. So that's kind of what we would expect. There's nothing that's happening before the monetary policy tightening. It's basically just zero. And so if this is happening in the way we would expect it, then when the Fed funds rate goes up, we would expect these yields to go up. So we should see it going up after the monetary policy tightening. And look at that. It does go up nicely as we would expect. You can see it kind of looks exactly like that Fed funds increase that we saw before. And then the other thing, as I mentioned, is that most of these 95% confidence intervals do not include zero. So that means that in general, they're statistically different from zero. So that's kind of what we would expect to see. So now we want to do the same comparison, but we want to do it for these corporate green bonds. And so I've kind of just changed the color of the dots so it represents these green bonds. And now if we look at the period before the monetary policy tightening, we see the same sort of thing. They're a little bit lower, but generally speaking, they're kind of around zero. And again, these confidence intervals more or less always include zero. So statistically, it's not really that different from zero. And so then again, what we probably be expecting if this goes along with theory is that this would go up again as the Fed funds rate goes up. But we don't necessarily see that with green corporate bonds. And so you can see there's a bit of an increase, but it's nowhere near as large as it would be for the non-green corporate bonds. And in addition, in most cases, or in a lot of cases, it includes zero. So that means it's not often that it's statistically significantly different from zero, the interest rate on these green corporate bonds. So this seems to suggest that there is less monetary policy sensitivity for this green investment, for these green corporate bonds. And that's kind of an important difference. And also that's kind of useful because it means that if we had questions about if tighter monetary policy is going to reduce green investment, that doesn't necessarily seem to be happening. So this is kind of a positive thing for climate change. Green investment might be able to stay elevated even if we have tight monetary policy. Okay, and so this is just so you can see it for comparison, but you can kind of see these broadly line up, and you can see here that the green corporate bonds don't seem to have yields increasing as much as non-green corporate bonds. And that difference is significant. So that's kind of the main conclusion on monetary policy. It doesn't seem to be affecting green corporate bonds that much. So I have some other work where I look at what might be driving these green corporate bonds. So the chart just on the top left is basically those green corporate bond yields. That's the black line, which just traces the median green corporate bond yield over time. And you can see it's kind of going up and down. The thing I showed earlier is that this doesn't necessarily seem to change that much with monetary policy. So that's kind of one conclusion. So what it might change with is this on the bottom left here, which is basically just measuring climate change awareness. So this is basically Google search volume for the phrase global warming over this whole period. And basically the work that I have conducted shows that in periods where there's a lot of Google search volume for global warming, so there's a lot of climate awareness, then there is a decrease in these green corporate bond yields. And so that means that during these periods of climate attention, it's cheaper to invest in these kind of green projects, which again is useful for filling that kind of shortfall that I talked about before. So this could be one thing. So really the conclusion from this is it's good to stay attentive to the climate. So I've showed that awareness to climate change kind of creates market conditions that are favorable for this green investment. I showed this chart earlier that said that these green investment requirements are going to be substantial in the future. And I showed one more optimistic thing, which is that they don't seem to vary that much with monetary policy. So it's not like higher interest rates from the Fed necessarily decrease green investment as much as you might think they would. Okay.
Thank you, Thomas. And we have a few minutes before our break for questions in case we haven't answered all of your questions. And George, do you want to go around with the microphone? Do you have a microphone? Yeah, so everyone can hear.
Thank you. I have a couple quick questions regarding the commercial real estate space. Nothing took a hit harder than office space when COVID hit. You know, it's almost like a cliff. There wasn't even a downturn. It was just fell off the cliff. It's really not recovered. So, you know, we're looking at in terms of, what do you call it? Rent or whatever, and then this. So with this whole need for housing, it would make sense that since the footprint of a lot of corporations has shrunk considerably since COVID, and we have all this space available, that they should be looking to convert them to condos, apartments, multifamilies, that kind of thing. However, the cost to do that is so onerous to a developer. How in the world how is government, the only way you can really do it is tax credits, significant tax credits going out into the future, or assistance of some sort. That's question number one. The second one you mentioned.
We have a lot of questions, so you only get one.
I know, but this has to do with the Hollywood industry because I kind of work in that space. Finding short-term furnished housing for the above-the-line people working on film and television productions. 6 or 7 years ago, 6 years ago, the entire industry left California because the state of California would not provide tax credits for the above-the-line people working on these productions. Other states did. Georgia was one. And so they just picked up the entire industry and moved there, built out the studios, and that's where everything is happening. That is a big reason why we don't have production here. Nobody
Okay,
can.
so we have a lot of questions, so I'm going to take your first question, which has to do with what's happening in office markets and conversion to residential. Modern office buildings can't be converted to residential. They physically can't be because of the nature of a modern office building, unless people change their preferences and want to live in places with no windows. And so modern office buildings, you're going to see, and we're already starting to see a rebasing of the asset values to a much lower value, lower rents that kind of appeal to companies that are doing hybrid work, restructuring those. Older office buildings can, and some of them are, and we have examples of that in downtown. So, so there's going to be some, but it's not going to be very much. It's mostly what we saw in retail, economic growth and a change in asset values is going to, over the next 4 or 5 years, resolve the office market, but that's got kind of a long ways to go. Okay, another question. Yes, Thomas.
I noticed in your in the forecast you didn't mention multiple wars going on, and I know that in the past that you've also said that California is in a position to unfortunately benefit from it because we have a defense industry here, and I wonder if you could just address how those two things will affect the outlook.
Yeah, I mean, typically, and we have built in the more dangerous world, but maybe not as dangerous as it might become. Typically, conflicts create a demand for defense goods. And so it's not a demand that you really want to have created, but the conflicts are there. And so we have increased demand, not just from the US, but also from our allies for defense durable goods. And that disproportionately affects California, especially Southern California. It impacts our aerospace industry in a positive way. Also, a few other states such as Texas and Georgia and Connecticut, but not a lot else. But in our US forecast and in our California forecast, we built in an increase in the demand for defense durable goods. And so that's part of that growth in manufacturing. I showed you tech manufacturing, computers and electronics, because that's where we had this decline, but also look for growth in defense goods. Okay, and let's see, do we have a question from over here? Yes.
Just real quick, this question is for Clement. Regarding the Chinese economy being so slow, maybe possibly exporting deflation, demand for oils there it's lower. How is that impacting the inflation rate in the US?
Sure. Oh, my microphone's on. Okay, so certainly I think that there is a large concern with the growing US-China economy. And on top of that, but there is some still uncertainty whether that slow growth is going to continue, right? So there is certainly structural events in the Chinese economy, such as the real estate sector, which is indicating that it is going to persist for a long time. But there's also other parts of it, such as their tech development, and on top of that, their new aggressive stimulation of their economy that might lead to some boost there as well. So we don't have in the forecast very strong deflationary pressures from the China economy. On your oil question, certainly in the forecast, we have lower oil prices because reduced demand for oil from China, and that feeds into it. But there's a lot of uncertainty going forward with oil prices because of the conflicts in Gaza and so on. So it's very hard to make a judgment call on where oil prices are going to go, especially we just seen what happened over the weekend in Lebanon. And at the same time, last week also OPEC came out and said that they were slated to cut oil production, and they just did a U-turn. Now they're saying, actually, you know what? No, we don't want to give up our market share. We're going to just produce, I think it's another million. Saudi Arabia said they're going to produce another 1 million barrels of oil by the end of this decade. And so that's going to create more, deflationary pressure on oil prices as well.
Yeah, and for more on U.S.-China economic relations, William Yu and myself write an article twice a year that's published by Cathay Bank and sponsored by Cathay Bank on U.S.-China economic relations. And so that's a little deeper dive. You can find that on our website. Okay, next question. I think there was a question right here.
Thank you. Yeah, this question is for Thomas. Thomas, were you able to tease out the yield discount associated with a green bond versus a corporate bond for corporate issues? Was that something that came out of your research?
Yeah, so definitely the research tackles that. Basically, some of the existing research in the literature has been conflicted on this. So some studies find that there's not really any kind of discount or difference. Some find that there is, so it kind of varies. One of the purposes of this work and some broad agenda I have is to just show why that's the case. And one of the big reasons is that it changes a lot over time. So a lot of these studies use very different sample periods, and as a result, they come up with differences. So I think the real conclusion to that is that sometimes there is a discount, and particularly, as I mentioned, those periods where there's high climate attention, there's definitely a discount during those periods, but it's not always there, and it kind of depends on a broader range of conditions that you really need to investigate.
Yeah, I think it was Clement, but I'm really interested in this discussion around unions and strikes and the impact. We're facing one at SoCal Gas, and I'm curious, I think the comment was the purchasers prepare themselves for this. Do you see that across industries, especially in the energy industry?
Yeah, that was my comment.
I'm sorry. My apologies.
So here's what the economics literature that has studied labor actions, whether they're strikes or lockouts or kind of whatever, has found, and that is that to the extent you can have stockpiling, you will have stockpiling. And to the extent that you can catch up after the labor action, you will have that. Wherever you have perishable goods, so think an airline strike, you can't stockpile trips, right? So that is a loss. And so that's the way to think about it. And for example, in the last writers' strike, not the last one, the one before, you saw stockpiling of content before, you saw catch up afterwards, but the perishable parts, such as the support industry, including things like catering and that was an absolute loss. So that's the way to think about it in terms of utilities as well. And question over there.
Yeah, this is a comment or question regarding EVs. I think, Clement, you mentioned that the EV sales have decreased or slowed down. With the slowing down of EV sales, as well as the increased cost of fossil fuels, has there been any analysis on increased investment in synthetic renewable fuels?
I don't have much knowledge on the state of, to say, the hydrogen fuels and where they're going to, from my understanding in terms of automobiles, that's not a scenario we're getting into.
I think my question was more in terms of like the ethanol fuels and the conversions of internal combustion engine to renewable energy, which is less polluting because the process of manufacturing it pulls carbon. So it's still considered carbon neutral, but I think the cost has prevented it because it's still a lot simpler to pull fossil fuels out of the ground as opposed to manufacturing which is quite expensive.
I mean, one thing we're really seeing is that the cost of producing electric vehicles is coming down rapidly, right? And so that's also going to feed into this, forecasted decline in the price of vehicles. And so I don't have a specific answer to whether that's going to play a big role, but I'm very doubtful, because I think that, hybrid and EVs are going to become affordable enough quickly that we're not going to need that type of alternative fuel base.
Another energy question. I saw somewhere in the last year that California electricity is about 70% above national averages. And just curious, as we keep using exponentially more and more energy, data centers and electric vehicles, and is that energy forecast in this forecast at all, and how we look at the transition?
Yeah, so the energy demand and the limits of the grid with respect to these large data centers that are supporting AI are not specifically in the forecast. But one thing that we're starting to see is that those who want to have a reliable source of energy for their AI data centers are actually organizing that in the beginning. So think about the restarting of the reactor that didn't melt down at 3 Mile Island, or the latest proposal, which is to tap into geothermal energy with a large facility in the Salton Sea, and other nuclear power plants that are no longer economically viable for generating electricity for household consumption, may be economically viable to support these data centers. So I think that, the question is really up in the air as to how this projected demand, which is in excess of what we're producing today, is going to be resolved. And I think we have time for maybe one more question.
This is a question related to the housing affordability. You mentioned that you don't see a near-term fix in closing the gap between supply and demand, that it's going to take multiple years to close that gap. Do you see housing affordability and price inflation continuing to get worse, or do you see it stabilizing?
So first, I just want to correct something. I made no prediction that California housing would ever be affordable. But there's something to that, and it really relates to to what we're talking about today, particularly in the second part of our program, and that is that as you look at where we are today, or if you are here for our December program and see how nice it is outside, and think other parts of the country, or the summer program and think about Houston, for example. As climate change changes the quality of life differentially in different parts of the country, it will impact us here, no doubt about that. But it's not going to be the same impact elsewhere. California becomes increasingly attractive. That means that the demand for housing, for California housing, not just by Californians, but kind of nationwide and indeed worldwide, is going to be going up, kind of to the extent that we can't build fast enough in kind of the foreseeable future. A few years ago, estimates were made that to get the premium for living in California down to where it was 25 years ago would require 3.5 million new homes, and we're producing at 100,000 a year, right? So not making a dent in it. There's also a supply side constraint. If we increased our home production to 300,000 a year, we need 500,000 people to be building those homes, and we don't have them. So that's a long way of saying Yeah, California housing premia are going to stay high and maybe even go higher. And that brings us to our break. We're going to take a 10-minute break and then come back to a really great keynote and panel. So let's be prompt in 10 minutes and we'll start again. Thank you. Good morning once again. Our break time is over with. So if I can ask you to return to your seats and we'll start the second part of our program. Okay, folks, if you would return to your seats, we'll start with the second part of our program. Okay, we have a great program now focusing on climate change in the economy. And our keynote is Rosanna Xia. And Rosanna is an environmental reporter for the Los Angeles Times, where she specializes in stories about the coast and ocean. She was a Pulitzer Prize finalist in 2020 for explanatory reporting and her coverage of a toxic dump site in the deep ocean, which I'm sure you read about maybe multiple times, and has been cited in the Best American Science and Nature Writing series. Her award-winning book, California Against the Sea, has been praised as poetic and mind-expanding exploration of what we stand to lose in the face of rising water. So really important for us here in California. She's a graduate of Tufts University with a concentration in quantitative economics. We like that. And international relations, and studied economic development at the Catholic Institute of Paris. Please join me in welcoming Rosanna to UCLA.
Thank you, Jerry, and also all the good folks at the Anderson Forecast and Teresa and Maggie and the UCLA Center for Impact. Oh my gosh, it is really, really nice to be here. And, so many great insights from the opening session. And I was just looking at the rest of the agenda for today, and I'm just really inspired by the brain power that this conference has brought together. And these are not easy issues, as everyone in this room knows. And I'm just so grateful for the expertise that you are all bringing to the discussion. And it is an honor now to share some of my thoughts with you and to share some lessons that I've learned in the process of writing this book, which looks at climate adaptation for a number of communities along the California coast and how we're responding and not responding to the realities of sea level rise. So I'm going to be focusing my remarks on mostly sea level rise, but a lot of this will also be applicable to other realms of climate adaptation. And just a quick note on the two photos that you see on the slide. Who here has been to Capitola, before? Here's Santa Cruz. Yeah, like a really beautiful, idyllic beach town near Santa Cruz. And so this is actually the cover of the book. And it's ironic, my publisher's art director had actually designed this cover before the winter storms hammered Capitola. And she had just thought that this would make a great book cover, super iconic town, really colorful, what a lot of people think of when they think of the California coast. And I still get chills thinking back to early 2020, right before COVID hit. There's a chapter early in the book where I'm walking with Gary Griggs, a really prominent professor at UC Santa Cruz, kind of the grandfather of coastal geology in California. And we're walking along this wharf in Capitola looking at all these colorful buildings. And he told me that day, not too long ago, all of this will have to inevitably face the realities of sea level rise one day soon. This is going to be so different one day. And I don't think either of us thought that day that one day soon would be January of 2023. So I think my first big takeaway to share with you today is that in California, at least along the coast, and I'm the coastal reporter for the LA Times, I'm mostly focused on coastal communities, I'm rarely running into climate deniers these days in California. The debate and the denial isn't whether climate change exists, it's how much time we have. And we're constantly being hit with reminders like these storms that we have even less time than we think. There we go. Oh, shoot, how do you go back? Okay. And just one more note on time. This book took me so long to write that I joked once with my editor that I was afraid the title would be California in the Sea by the time I finished the book. So I'm about to throw a lot of numbers at you that you've probably already heard before, but I have this slide here to help make the point that this used to be the default way we always talked about sea level rise. This is how we've traditionally presented flood projections and vulnerability assessments to the public. And this is how many of us in the room probably think. You know, as folks who work with the science and the numbers, we see these numbers and go, holy cow, we feel the urgency and the need to act and just the gravity of the situation. And so for years, I also followed this rhythm of communicating the issue. So with each of these numbers, I did the old school newspaper approach and wrote a news article every time a new number came out. A new study found that more than 2/3 of our beaches in California could drown by the end of the century. A new study found that more than $370 billion of property in California could be at risk of flooding by 2100, et cetera, et cetera, et cetera. I'd break the news, it would make a big splash. The story often went on the front page. People would go, oh my God. And we have to do something. There's this whole news cycle. But then the next day, people moved on to the next thing. And so that's when I started to realize numbers alone don't tell the whole story. People tend to remember the stories you tell them, not the data. And people tend to remember how they feel rather than the facts that actually triggered those feelings. And so I realized that it is my job as a reporter and writer to help people also make more meaning out of this data. And I'll never forget talking to this highly respected coastal engineer a few years ago. We're walking along the beach in Northern California. And he told me, after feeling pretty defeated and pretty beat down after being yelled at during like 5 hours of public comment at a city council meeting, just that sea level rise is no longer just an engineering problem. It's a social problem, he told me. It's a political problem. He told me he's done all the cost-benefit analyses. He's determined what is the most cost-efficient, most life safety way forward for a community, but no one wanted to listen because these changes demand sacrifice. It costs people something. And in the communities where he presented these facts, the backlash was just huge. And it became an emotional conversation rather than a conversation based on just what the numbers were saying. And he was like, Rosanna, this is way beyond my expertise. We can't science our way out of this problem. I'm reminded too of a quote that I heard recently from Naomi Klein, who just wrote a brilliant book on conspiracy theories. And she told me, conspiracy theorists tend to get the facts wrong, but the emotions right. And I feel like I've been thinking about that statement ever since. And I think it's just really important to also remember the emotional aspects of this conversation. That's often where we have to start when we talk to people about this issue. And even if our work is grounded in what the facts and numbers say, I think we have to remember the emotional aspects. Okay, so I was thinking about what to share today with such a smart group of folks. And these next few slides will be just a mishmash of some of the questions and themes that have come up repeatedly in my conversations with folks up and down the California coast. And consider it some food for thought as you spend today reflecting on all these various aspects of the issue. So I'll start with one of the most fraught questions that always comes up when I'm talking to folks about this. What is the role of government when it comes to maintaining property values? I'm just going to say it. And how should we be thinking about all the systems currently in place that prop up property values? There's a quote here on the slide from A.R. Siders, a prominent climate adaptation specialist at University of Delaware's Disaster Research Center, that gets to the heart of things. Should the purpose of government be to keep people safe, or should it be to maintain property values? And then our conversation continues to go on for her to say that right now, we still do tend to get stuck in this loop of trying to maintain property values because that's what stable feels like to us. And there's also a lot of political pressure to do so. And also take things like property taxes, for example. We have created a system where a lot of these small towns along the coast also rely on property taxes and tourism taxes from hotels, from their wealthiest property owners who live right on the beach. And these tax revenues help boost the town's operating costs. I have talked to so many smaller coastal towns in California where, if you look at the percentage of where their revenue is coming from, what's supporting their general budget, to think about what it means to rock that section of property taxes is actually kind of, humbling to think about. And so what happens if you do let the waterfront fall into the ocean versus pouring just repeated costs into defending in place and holding the line every time the ocean tries to move in? And who here in the room has heard the term managed retreat before? Oh, wow. Okay. So for all of you who have not heard the term, you have been spared quite a bit of pain and stress and anxiety. And just, for those who have, I know you're laughing, but, managed retreat is probably the most controversial, most fraught, most poorly branded term in environmental policy. It has been internalized by a lot of folks in a lot of ways, but ultimately it just means acknowledging that a disaster will hit a neighborhood, a town at some point, whether from wildfires, whether from flooding, and just designating this zone as a place that might need to relocate in the future. And what does that mean? So along the coast, it's just acknowledging that the ocean's pushing inland, we're supposed to move with it, and what does it mean to mindfully create a bunch of steps to get out of the way before we're in the way. But a lot of questions come up when you think about policies like this. We have property owners asking, how does that affect my property value to designate my property as something that needs to be potentially relocated in some undetermined amount of time? What does that mean for me now? Can I get insurance? How does this affect my ability to get a mortgage and refinance my home? And even if you mark a place, someone called it a scarlet letter A on her property. Like those are kind of a lot of unanswered questions right now that have caused a lot of very intense conversations at the community level. And just, kind of going back to this point on time, we have been forced to make decisions in timeframes that don't necessarily sync up with climate change. 30-year mortgage, 2- and 4-year political terms, 100-year infrastructure life cycles. If you think about 2050, which has been this major threshold tipping point that it comes up a lot in climate change conversations, 2050 is less than a 30-year mortgage away. There's also a lot of uncertainty with insurance, which I know we'll be talking a lot more about today. You've probably seen all the recent stories about how private insurance companies are pulling out of wildfire risk areas and flood risk areas, and also just how expensive insurance has gotten in some places. And so in that vein, what is the role of government in keeping things stable? Insurance companies in some ways are truly the best at calculating risk and assigning a financial framework to think about these risks, right? But when they start pulling out, should the government step in and take on these risks that so many insurance companies are no longer willing to take on? And the example that I tend to talk about in cocktail parties, I am a very fun cocktail party guest, is earthquake insurance in California. For example, with earthquakes, the insurance market decided years ago that's too arbitrary of a risk and too big of a risk, when the big one hits. And so the state had to step in and created the California Earthquake Authority to basically stabilize the market after the Northridge earthquake. But if you apply that to floods and wildfires and looking at just the history, for example, of the National Flood Insurance Program, and even just how stretched thin FEMA is right now responding to yet another hurricane with all these emergency responses and the multiple over $1 billion disasters that are magnifying and increasing in frequency, these are tough questions to seriously consider as we think about what it means to maintain stability. And again, what is the role of government in all of this? Just a last note here, just one climate adaptation expert described it to me once as, it feels like a lot of dominoes have been lined up and we're just not sure who's going to push that first one, the market forces or the government. Everyone's still kind of waiting to see. And in the meantime, a lot of people are kind of looking at the insurance industry as possibly the first domino to break. But, ultimately, I would just say here that the way we've propped up property values, the way our systems have been created, also create a system where a lot of people today still have a distorted sense of what the real risks are. Okay, so working on this book also prompted some interesting philosophical questions on what traditionally gets assigned a value in cost-benefit calculations. We've traditionally centered property loss in our models, for example, because we have such an established system to assess property value and analyze property value and property loss. We even have ways to calculate the cost of business disruption if we shut a port down for a few days, or how much extra money it would cost to reroute commuters onto another highway if we close down one highway for whatever. But what about the less tangible values of protecting a beach and restoring a wetland? Or even how do you calculate the value of not cutting down a tree? And how do you measure and assign value to a community's well-being And the math can change quite a bit depending on how we assign these values to these different pieces that don't get traditionally put into a cost-benefit model. And there's been a lot of movement in the environmental planning space to think more broadly and expansively about what it is that we value as a community. But I think there's no standardization yet, and I think there's a lot of room to grow here. And ultimately, I've seen a lot of planners kind of also start these conversations at the community with the community by asking them first and foremost, what do you actually want? Like, what do you want your community to have, and what do you want your community to look like 30, 40, 50 years from now? What do you think we should prioritize rather than hiring a third-party consultant to hide in the back room and do the cost-benefit analysis and the vulnerability assessments and then drop it on the community and tell them what they should be prioritizing and what they're about to lose? What does the community think is essential to protecting their future? So I've been seeing these shifts in how the conversation starts at the community level, which I think has been really powerful. Also, just this very idea of critical infrastructure. We talk a lot about the things we need to do to keep critical infrastructure, stable. And what makes infrastructure actually critical? This is what I get to do as a writer. I start thinking on very meta levels. And there's been a lot of news in the last kind of couple winter seasons on, for example, keeping the coastal highway open along Big Sur. And anyone who's driven Big Sur is this highway is a feat of engineering. And to keep it open repeatedly with all these landslides and coastal erosion is now kind of an existential question that community is wrestling with. Similarly, every time Pacific Coast Highway shuts down Malibu, I think there's a lot of conversations about, oh my God, PCH is actually a critical lifeline for the community. That's for a lot of folks living in the canyons, that's the only way to get in and out if a fire happens, if you need to go to work, if you need to go to school, if there's an emergency and you have to go to the nearest hospital. But also, I think the train to San Diego has been another iconic critical infrastructure conversation in the sea level rise space. But what makes it critical? And it's interesting that we have created this feedback loop for ourselves. We couldn't build and live in Malibu until we built PCH. And now that PCH exists, we can continue to build. And now that more people live there because we've made it possible to live there, we now need to keep PCH open even more intensely. And so this is a loop we're stuck in. It's maybe something we can't change, but I think ultimately, we can at least acknowledge it and recognize the things that, the cards that we have been dealt, the cards that we might not have chosen, but also what are the possible ways to kind of slowly reshift in a different direction. And someone once explained to me super simply that an economist helps turn climate uncertainties into risks that we can then make more mindful decisions off of. But making sure we are considering all of the pieces beyond going down the standard checklist of what is traditionally included, and just assuming what is critical and not critical to a community is also super important going forward. And just a quick note here on the notion of compounding disasters. Traditionally we have modeled disasters in silos. The sea level rise people do the flood projections here. The extreme rain precipitation people do their models here. The wildfire people live in a totally different landscape. And carbon emission folks are totally somewhere else. And, but what happens if 2 disasters happen at the same time, or 3, and this is something that we're seeing increasingly, and scientists are really starting to shift the way they think about their 100-year storm approach. And so, if, for example, and this happened in Capitola last year, if it's a high swell and the ocean's trying to move in, and the rivers are completely at capacity because it's like the 5th atmospheric river and there's no more room for the river to absorb water. The river's trying to push into the ocean and flush all the water out at the same time. The soil saturated, cannot absorb any more rainwater, and the groundwater is even rising. That's where you see a really intense flood and everyone's like, oh my God, yet another 1 billion plus disaster. But it was almost like 3 different model predictions coming together at the same time, and we didn't really have the capacity to think through what that looks like. And so, more and more often we are seeing multiple disasters occurring in one season, sometimes at the same time. And so the question for all of you is, how do we account for that as we do our modeling and projections and risk assessments going into the future? Another tension point that I've come across a lot is just this notion that responding to sea level rise hinges on these big one-time actions. There's so much pressure right now being placed on whether a city council votes to include the words managed retreat in their planning document or not, or some other big vote at the Coastal Commission that feels so make or break. But adapting to sea level rise in reality is a process. And we all know, on a gut level that the world that we love and know today will somehow look different 30, 40, 50, 60 years from now. But we also know that none of these changes that we have to make need to happen today or tomorrow. So I think kind of a meta question is, how do you help more people shift from this short-term thinking into making those first small steps toward longer-term, more radical changes? How do you help people enter that middle space or that transition? How ultimately do you make that process feel fair? And I think the sense of fairness is so key. Like this question of how do we help people enter this process in a way that doesn't feel like we're asking someone to give up everything in one go? That is so important. And we so often frame this conversation of climate change adaptation as a conversation about what it is that we have to give up, what it is that we have to sacrifice. But it can also be reframed as a conversation about what we could gain as a society, as a community, if only we started this visioning process now, before it's too late, before the disaster hits. Disasters, plural, occurs. And I think, so my book editor, even more philosophical than me, she posed this question to me early on in my writing process that really transformed the way I thought about a lot of these things. She asked me, Rosanna, what is the difference between loss and change? And I just in that moment was like, whoa. And and for all the numbers people in the room, maybe the question here is, how do we measure change, and how do we measure that differently than loss? And I think that's this idea of change and not having it necessarily be a bad thing has been really transformational for me. I also just want to touch briefly on an interesting idea introduced by State Senator Ben Allen a few years back, Senate Bill 83. And this idea was so uncharted that he actually tapped Julia Stein's research team at UCLA's law school. Shout out to the Emmett Institute on climate change and the environment. He tapped Julia's team to help him develop and think through some of the mechanics of how this policy would work. So it went through 2 cycles in the legislative session. The first version was called Senate Bill 83. I was going to put up just my LA Times article, but I thought I'd shout out Nathan Rott at NPR, who's also been doing a lot of really thoughtful work on this issue. In a nutshell, Ben Allen was thinking about the short-term versus long-term and the transition period. And he said, how about, okay, so property values and all this stuff is what's getting people stuck. How about we designate a place that might be a place that needs to relocate in the future because it's at increasing risk from wildfires or flooding. We buy them out at market price, so all the property owners feel whole. And then we rent out those properties for the next 30 years as Airbnbs, maybe have a land trust take care of it, maybe set up some kind of government entity to do it. And that rent will earn back the cost it took us to acquire the properties. And when the time comes, rather than continue to throw millions of dollars at the problem to stop the ocean from inevitably moving in, why not demolish those homes at that point, that later uncertain point in time, turn it back into a wetland, turn it back into a park or a dune system, and just, again, this transition process. And so, of course, I think that it was an interesting idea because he really was acknowledging the elephant in the room, which is that real estate in California, especially along the coast, is very, very, very expensive. And I remember seeing once after Superstorm Sandy on Staten Island, I think it cost $120 million to buy out 300 homes in Staten Island. And I'm sitting here thinking, and everyone's like, this is such a great buyout approach, yada, yada, yada. And I'm thinking okay, $120 million, that would buy maybe 10 homes in Malibu if we were lucky. And so the math just doesn't add up that way in California. But getting ahead of the disaster does add up for California. There's a report that came out a few years ago by the National Institute of Building Sciences that found that society as a whole saves $6 in avoided costs for every $1 spent to acquire or demolish, a flood risk property or building before the disaster hits. So I think those were some of the numbers that Senator Allen was also working with. And he built his case. He had a pretty unanimous support at the Senate and the Assembly level. The bill ultimately got vetoed by Governor Newsom twice with kind of a chicken and egg message. He said, we need to figure out how this works before we try to see if it actually works. And I think that this idea is not perfect. There are no perfect solutions for climate change adaptation, but, and for the record, this will not be the solution everywhere. But what has really struck me about this process and this idea is that there is a team of people who really tried to think outside of the box while also still working within the systems that we have inherited. And I think I would encourage all of you to think more creatively. We need more creative conversations and ideas like this. And again, just ultimately what we need to do is help people move from the short term into the long term and to recognize that there is a very long process and transition in the middle. So in my last few slides, I'd like to just share some more philosophical thoughts with you. In the course of my reporting, I also started to think more deeply about who we tend to value as expert. You know, lawyers, scientists with peer-reviewed studies, historians and anthropologists who published and earned their PhDs. But where does indigenous knowledge fit into these conversations? What about frontline communities and their lived experiences that are more anecdotal than, data heavy? How do we center their voices in a conversation that has largely ignored or overlooked their needs? And there were just so many communities that I got to know up and down the coast, for example, where there was no data to back up the fact that air pollution has been affecting their health, or that their life expectancy felt lower than other communities just down the road. And they have a feeling it has to do with that toxic, cleanup site that never really got cleaned up. And it was because no data existed because no one had thought to look into it or to dedicate their research project to it. And because there was no data quantifying these problems, the policy priorities in the county went elsewhere. And that's the definition of being overlooked, right? And so how do you acknowledge and validate these anecdotal experiences, these lived experiences in a world that largely operates on looking at where the data points us? And so, as a journalist, like one of our rules is like you have to talk to all sides on an issue. So there's like a checklist where you're like, did I talk to this person, and looking at all the people at the table and making sure I talk to every single side. And then there's a moment in my reporting process once I've done that where I also think, okay, talk to everyone at the table. Who isn't at the table that also needs to be proactively brought in? And so that's like 4 more months of reporting for a story. As a journalist too, I am so conscious of the fact that when I quote someone, I give that person power. When I choose to tell someone's story, I give that story power. And writing a book about this issue really gave me the opportunity to think more deeply about how to share that power and to ultimately maybe redistribute that power. And so I would encourage all of you to also think about how to share and possibly redistribute power within your own lines of work. And this quote by Hopkins really hit it home for me. He wrote this powerful essay in Sierra magazine a few years ago called "Racism is Killing the Planet," and I would encourage everyone to read more of his work. As we look to solutions and ways to reset our relationship with nature, it is really, really important to remember that our history of land use, the way we've redlined communities or disinvested in some communities, has allowed for sacrifice zones. That's a term that's come up a lot more in environmental planning spaces these days. We have created a system where it's okay to protect nature here for this community and then sacrifice this other community for the power plants that need to be built and the recycling plants and the refineries and all the landfills that we still rely on, even if we don't want to emit it. And we still so often operate on this idea of scarcity, that there are winners and losers, that one person's benefit, one community's benefit comes at the cost of another community's. And so how do we make sure we aren't helping one community survive climate change at the expense of another? And this conversation has certainly expanded quite significantly in the last few years. And I've been really encouraged to see how much our environmental protection efforts have also started to extend to vulnerable people and vulnerable communities, but there's just still so much more to consider. Our generation today didn't necessarily create these injustices, but it is on all of us to make sure we don't continue to perpetuate these historical inequities. And it begins with recognizing and owning up to these problems that got us here in the first place. There are communities living next to toxic waste sites that have fought for years, for decades for cleanup, long before sea level rise even became such an urgent threat. And sea level rise has now only accelerated the problems that so many overlooked communities have already been struggling with. So for me, when I enter a community that we would define as environmental justice, and I am like, I want to talk about climate change, I want to talk about sea level rise. They're like, we want to talk about this Superfund site that it's been a problem since 1970, and now we're worried about all these other issues. And I think it's also meeting a community where they're at in their language and realizing that all of it is ultimately connected to things that we have to think about for the future. Okay, going even deeper for one more slide. As a writer, I really wrestled with the word resilience. I'm sure everyone has seen that word at this point in a gazillion reports and articles, and it comes up so often, this word resilience and climate adaptation, but what does it actually mean to be a resilient community or a resilient coastline? And so many of us have internalized this word to mean having the strength to remain unchanged. Katrina levels New Orleans, and we shall rebuild exactly what we lost and exactly where we lost it. The insurance system has also historically been set up this way. If fire burns down your home, you get to rebuild that home in exactly where it burned down. And is that actually what we should be doing? I think that's a question that really started to stump me as I continue to go deeper in my reporting. So I'd like to read a short passage, if I may, from chapter 7 of the book, where we meet Charles Lester, who really helped me start to expand my own thinking about this word resilience. And this will be just a nice way to tie up some of the themes introduced today. Some of you might already know Charles. And for those who don't, he was the former executive director of the California Coastal Commission, and he's now leading the Ocean and Coastal Policy Center at UC Santa Barbara. I was such a geek, such a reporter. I was starting to pose to every single person I interviewed, what does resilience mean to you? And then Charles told me his thoughts, and I'm like, okay, this is a whole chapter. Okay, so the he in this passage is Charles Lester. He's been mulling over this word, resilience, that comes up so often with climate change. For those still thinking in terms of man versus nature, resilience means having the strength to rebuild in the same place after a catastrophe, to resume life as it was before. The standard way we talk about resilience is this ability to bounce back, Lester said. Resilience is often about making sure we are strong enough to not be changed, but what if we should change? More and more sociologists, economists, even engineers are now questioning who exactly benefits from preserving the world the way it is today. Whose wealth, whose property, whose history gets preserved by maintaining the status quo? We've seen increasing gentrification and disparities in wealth. We've seen the cost of housing in the coastal zone go through the roof. And we've seen an exposed, impoverished political system that in many cases is driven by power and vested interests, as opposed to larger interests of society and the community, he said. So in my mind, we need to figure out how to adapt, but it's so much deeper than that. He pulled out a paper written in 2020 by Brian H. Walker, a renowned ecologist in Australia who poses a broader way of thinking about resilience. Resilience includes knowing when an unwanted transformation is inevitable, Walker wrote, and instead deliberately transforming all or parts of the system such that the new system delivers what is valued and wanted. I'm going to flip to the last page. Adaptation ultimately is about choice. It's about choosing what to preserve, choosing what to let change, and choosing what to intentionally change in a new and reimagined way. To resist change is to miss out on opportunities to create a better future. To remain unchanged is to buy into the long-held myth that the world today is as good as it gets. To ignore this choice to mend our relationship with the land and with each other is to believe that the systems we're still holding on to, systems built on social inequities, historical injustices, and the willful control of nature, are the way that things should always be. And so ultimately for me, the story of climate adaptation along the California coast has become an examination of our capacity to change, to re-examine the systems that we have come to accept without thinking, the systems that got us into the situation in the first place, and to think about how we could possibly unwind maybe some of those systems in the process of preparing our communities for the future. Again, responding to sea level rise can be an opportunity to have conversations that we've needed to have for a very long time. And it's an opportunity to redesign and reimagine and rethink some of the systems and infrastructure that are clearly already broken for so many of our communities. With that, I think we have time for a few questions before we dive into the rest of the day. Thank you all for taking the time to reflect on these very, very tough issues. We have a very long road ahead of us, but these are the conversations that we need to be having more of. And I'm just so inspired by everyone in this room. Thank you. We go with, Daniel has a question. So, do we have time for questions?
No, I don't think so.
Okay. Y'all can't ask me questions. Thank you all.
But I think we have so many questions because there's so much food for thought. So thank you very much for being here with us and sharing this. You know, economics is about the allocation of scarce resources and bringing in all of these aspects of climate change to the decision of how we allocate those scarce resources is really important. So again, thank you so much for being here and sharing all of this knowledge with us. Thank you, guys. And now if we can bring up our panel, and as the panelists are coming up, let me introduce the moderator, my colleague, Professor Magali Domas. Magali is the faculty director of Impact at Anderson as a professor of management here at Anderson, and also the Institute for the Environment and Sustainability here at UCLA, widely published and widely cited. And now I'm going to turn the program over to Maggie.
Thank you very much. What an inspiring talk. I think it was, it's so great to see how much information we would like to see, how information can change our behavior and should change our behavior. A lot of questions actually that we are going to, kind of build up in this panel. So on this panel, we'll kind of think about what do we know about, climate change? What are the tools to, evaluate risks? And so how does that impact our, kind of either adaptation, mitigation, our strategy? So we'll be listening to Elizabeth Chile from the California Air Resources Board, who is the Chief Research Division, and she's going to talk to us about climate and health in California, the analysis and the disparities, how different communities are, kind of impacted, and what type of projects have been put into place to mitigate or to adapt. We'll listen from Ben Preston, who is the Director of Community Health and Environmental Policy Program at the Pardee Rand Graduate School, about climate risks. How do you evaluate climate risks, the different methods, and whether and how does that actually lead to action? And then we'll listen to Jing-Hoon Lee, from the Mercury Insurance climate economist here at the UCLA Anderson Forecast, talking to us about climate risk and insurance. We've been talking about this a little bit. Before that, I wanted to kind of give you a little bit of a preview of what we're doing here at the UCLA, the Center for Impact, with the Open for Good platform. If I could get the next slide, please. Yes, so because like the landscape is changing, and we're talking with Ben about this, new regulations are born. So this is really exciting. We're talking about information. We're talking about, what type of information are we going to collect in terms of evaluating our greenhouse gas emission? How much, what type of information are we going to collect in terms of the risk and then the actions? Next slide. Maybe I can do the next slides myself. Can I? This is working. Yes. So we are special in California. We have these two regulations coming in, SB 253 and SB 261, and also regulations in Europe. These are information policies that will mandate the disclosure of carbon emissions from corporations. And this is already happening in Europe, starting in 2024, which is this year. And in the next couple of years, we'll have that in California. Why is it important? Because these require large corporations to provide information about not only their greenhouse gas emissions, but also some kind of risk assessment of the potential risk of climate on their operations, and also provide strategies on how to mitigate or adapt to these risks. So it's a lot of information that is going to be gathered. And this creates questions on what type of information is kind of important, what really matters. And I imagine these questions will be answered in the next couple of years. But this means for us, or here for corporations, for individuals, we need to kind of figure out how to measure these things and how to act. So just briefly on the Open for Good initiative at the Center for Impact at the Anderson School of Management, we are collecting disclosures on the S&P 500 companies on a host of measures, either environmental and social. And the idea is that we want to know where we are in terms of disclosure in the corporate world, looking at the biggest companies, those that have the most resources to do that. Where are we? Is it something that's feasible? And we're looking at greenhouse gas emissions. We're looking at also what companies say about their risks. And we're looking also at the type of governance they have in place to respond to these risks. We also look at the social issues. I'm not going to talk about it right now. So greenhouse gas emission, what do we see? So scope 1, scope 2, scope 3. So scope 1 are the direct emissions, scope 2 are the electricity consumed, and scope 3 is everything else. So we see that actually there's a lot going on already. 82% of the S&P 500 report on scope 1, on scope 2 is almost the same. Scope 3 is the difficult one. Scope 3 is really complicated. So we see here a little bit less. And by sector, we see these disclosures, in some sectors, actually, we do have, higher numbers. So why is scope 3 so difficult? Because it's kind of a host of things. We have 15 different categories here. It's, your purchased goods and services, but it's also your end of life treatment of your sold products. So once your products are leaving your company and they're in the hands of a consumer, how much is that, footprint? It's super vast and difficult and complicated. So, we're kind of learning about this. Actually, I'm teaching for the first time a class on climate strategy and analytics. So I'm learning myself a lot about that too. So what we have just issued our 2024 Corporate Sustainability Transparency Index. You are welcome to take a copy of it. This is when we look at these companies and all of these 500 S&P 500 companies, biggest, and these are the top 15 kind of disclosed. These are the companies that disclose the most. You can see on all of these variables that I mentioned, they don't do 100%, but it's a pretty reasonable percentage of disclosure. So these companies know already a lot about their footprints. When we look at this, and you can look at it in the report because this is a little too small here to read, but what we see is in green, they disclose, in red, they don't disclose, and in yellow, they kind of disclose. If I kind of, it's kind of partial disclosure, not exactly what we would like to see, but it's kind of the beginning. So whether you cannot read the left, but basically where we have red mostly is in the biodiversity level, in all kind of which is nature. And we were talking about this with our keynote speaker here, how much companies are evaluated. These things is not yet there yet. And on the governance, sorry, and assurance, most of these reports are not yet assured. There's no third-party verification. So that's where we see some of the progress that needs to be done. But overall, I think what we have is, regulations coming in. It's exciting, but all of us need to learn, including the government, actually, but all of us need to work together and learn about, how to measure this impact and also what to do with it. So this is really what we're going to talk about on this panel on, how do we do this and when does it lead to action? So the current reporting challenges are a lot on scope 3. Which are for any company, usually the largest source of emission, about 2/3 on average of the emissions are coming from scope 3. So climate data is going to be available much more. We just have to see what we do with it and how do we act on it. So moving on to the panel, I think the next slide. So we're going to start with Elizabeth from the California Air Resources Board. And so about, kind of your research at the California Air Resources Board on health and climate adaptation.
Great, thank you. I thought I was last, so I'm a little surprised.
It's the way you see it.
No, it's great to talk to y'all. I will come from a little bit of a different tact. I run the research division at CARB, so I won't really talk about the climate disclosure work. That's in a whole other group, and unfortunately, I can't really speak too much to that. But I think it's really important to think about the impacts on people's health from climate change and what we do with climate change, the mitigation actions and adaptation as well, because that does obviously have an impact on the economy. So I'm from the Air Resources Board, and obviously we are charged with protecting the public health from air pollution and developing programs to fight climate change. We have, as all of you probably know, we have quite a few really transformative regulations and policies. And one of the things that I do is look at the health impacts from those. So we look at the health impacts of the climate crisis that's already being felt by California. I live in Sacramento. Yesterday it was over 100 degrees. I think it might have been 100 degrees or close to it here as well. And in San Francisco, which is highly unusual. So these impacts are really the focus, part of the focus of our programs and research. And you can find out one of the things we did in the last scoping plan was really take a hard look at what are the impacts from climate change, as well as what are the impacts if you don't do anything about climate change. And I'll speak to that in a little bit. So just starting out on how climate and air pollution are linked together and why that's important. Climate change obviously brings weather conditions that are conducive to ozone formation, including the higher temperatures. And some recent studies have shown that in California, the average number of days per year with a heat index above 90 could increase by 60% from our historical baseline. And then that, of course, turns to increased smog, and that's often termed the climate penalty. And that makes it just harder for us to meet all of our air quality standards, which impact human health. So across our agency, we're working hard to look at this and also to assist vulnerable communities. I really appreciate that being brought up in the last conversation. So we really look at low-income and under-resourced communities of color, often with inadequate housing and limited cooling resources, and they face higher risks. Related to what we just talked about, vulnerable coastal communities, which also lack air conditioning, as well as the impact from sea level rise. And then the elderly, as well as pregnant women and outdoor workers. So I'll move a little bit to the scoping plan, which outlines the state's path to decarbonization by 2045. It also provides substantial health and economic benefits. So the 2022 update to the scoping plan will cut pollution by 71%, decrease greenhouse gas emissions by 85%, and result in a substantial increase in new jobs and huge health benefits. When added together, the health benefits of the scoping plan in terms of reduced hospitalizations, illness, and death add up to more than $200 billion. It includes a path forward, and one of the things we're really proud of is not just in the reduction of the use of fossil fuel and clean energy technology and the use of clean energy technology, but also nature-based solutions. And this is the first time that we had really integrated that into the scoping plan. And those produce benefits when you're looking at how do you decrease wildfires, how do you use prescribed burns, and what are the health impacts of that over time. So in that scoping plan, we conducted both a qualitative health analysis to demonstrate the many additional co-benefits of our plan for carbonization. That focused on 8 social and environmental pathways affecting health outcomes. So that's income security, food security, affordable housing, mobility, heat, wildfires, and children's health. So the goal was to evaluate health trends and impacts, as I said, under a no action and a take action. And we also did some quantitative analysis as well. So it shows how a carbon neutral future will have additional benefits in these areas. And an important goal is that all communities in California benefit. So our health analysis showed substantial quantitative benefits of climate change. I'll just mention a few of these. When you're looking at national working lands management, increasing the health of our forests can result in a 10% reduction of wildfire-related particulate pollution and an overall $3.1 billion reduction in healthcare costs. Increasing active transportation to 23% by 2050 through a mix of changes in land use planning and transportation options results in impressive health benefits A reduction in VMT, vehicle miles traveled, in one scenario found that 8,000 deaths could be avoided. And resilient communities are healthier communities. Ongoing research is important to provide the scientific knowledge we need to measure that. And we have an ambitious research program that looks at that. We're funding climate work to understand the health impacts of wildfire, health benefits of increased greenness, impacts of heat adaptation, and better understand climate impacts on vulnerable communities. And I'll just round out that we also get a lot of questions about what resources are available to help reduce climate effects. We have a community air protection program, which works with communities to help reduce air pollution risks and increase resiliency. Within that, there are community air grants available to nonprofits and Native American tribes. And that supports clean air and increased community health. Over the course of the program, $35 million has been awarded. We also have clean air centers, which is a pilot project that we've implemented throughout the state, which as wildfires are increasing, that allows a space kind of like cool air centers for people to go so that they can get away from the effects of wildfire smoke. And just to round it out, over the past 10 years, the California Climate Investment Program has invested over $11 billion in funding through 24 state agencies to support the state's work to equitable climate solutions. So with that, I will hand it back.
Yeah, well, thank you. Well, we'll go through some questions about this, but definitely this connection between health, the health benefits and climate adaptation is really, really important. I mean, I think for people, not just to see the cost, but to see kind of the benefits. So Ben Preston is next. I don't know why it's not, sorry. Well, we'll see each other, which is great.
Yeah. Now it's getting your ear.
Okay, go.
That's fine.
Ben, go ahead.
Yeah, no, I'll go ahead and dive in. So look, I've been doing work trying to assess risks of climate change and manage climate risks for about 25 years, believe it or not. What's been interesting over that time is sort of see the evolution of, climate risk assessment and management and risk-based decision-making evolve. So 25 years ago, when I got involved in this business, it was kind of this dark art that researchers like myself would do sort of behind closed doors. And it's now sort of moved into sort of mainstream practice. There's policy around it, which I'll say more about in a minute. So climate risk assessment's kind of grown up, which is fascinating. Specific examples. So Executive Order 14008, sort of lead off executive order from the Biden administration, really sort of set the expectation. If you're using federal dollars to build infrastructure, do anything, you better consider future climate risk as you do that. Seems like a really kind of wonky, innocuous sort of policy measure, but if implemented and enforced and eventually grounded in legislation, that'd be kind of a game changer in terms of societal resilience and adaptation. And that kind of thinking is now moved out of sort of the public sector and the private sector and in the financial arena with some of the California policies you just heard about, SEC rules on climate-related financial disclosure, and then also policies at the state and local level, basically requiring people to think about climate risk. So interesting area for people like me. So what? Right? So we have to leave this question of like, are we actually getting any value out of all of this energy we're putting into understanding future climate and understanding risk? And one could argue that the way you get value out of using these kinds of methods is by driving changes in decision making, getting people to do something different in response to information about risk. And that's actually a tricky story, right? So we know, for example, some things I work on, right? So I work with the Department of Homeland Security using this framework called the National Critical Functions, which is basically we're exercising that framework to look at how is climate change going to affect critical infrastructure assets and performance and behavior across the country. So this is how does climate affect power, water, infrastructure, how does it affect things like elections, delivery of healthcare services. So it's an interesting framework. We spent years now assessing the risk of climate to these infrastructure services. So we've got lots of data reports on that. So what? What do people do with that information now that we've told them, like, you really need to look at the power sector? What do they do with it? Does it drive changes in decision making? Similarly, all the assessments we see at the state and local level, we're telling people about risk, we're telling people about vulnerability, we're getting really good at telling people about exposure to physical risk and physical hazards. What do they do with that? What do they do with that if they don't have cost-benefit information around different types of risk management strategies? So there's some gaps there. A big gap is still uncertainty, not the old school uncertainty around climate, like, is it happening, is it a hoax? But more, how do we deal, as Rosanna said, with compounded events, not just in the climate, but maybe we have a hurricane plus a cyber attack. Like, how do we deal with those two different types of things? And I would argue that we're still thinking very much in short term when we're thinking about future risk and its management. For example, Helene is going to be like the news story we use to talk about, the vulnerability of society. But clearly, a lot of people didn't realize, were caught completely off guard by the severity of that storm and its consequences. I mean, we're missing something in our ability to assess risk. And also, we're going to treat that like a short-term hurricane, not think about what are the decades and years of decisions prior to this event that actually contributed to the losses that we saw. And then lastly, risk assessment management is often very sort of narrowly focused. But if we really want to get out in front of big challenges, big risks that are going to affect us, we need to move from this sort of quantitative risk analysis mode to more of a strategic foresight mode. It lets us anticipate things that are coming down the road. How are big changes in society, the economy, demography going to contribute to create risk? We do a lot of that work at RAND, both in terms of strategic foresight for different Homeland Security agencies. Recently, we've even stood up our own crowdsourcing prediction framework and platform that allows RAND folks and external users to come in and use this as a prediction tool for anticipating types of consequences that we're only now sort of starting to put on the table. So I'm going to stop there, but lots more to talk about.
Yeah, thank you. I mean, it's, the question of the information to action link. And clearly, kind of these are new methodologies for the corporate world have been already in place, these risk assessment tools for a while, kind of the city, state and country level. But so how do these things now go into corporations so that they, kind of, devise strategies? And so I think these new regulations coming in are going to request companies to actually devise strategy and describe what they are doing and how much investment they are kind of putting to address these challenges. So one in sector that has been actually talking and thinking about risk very, very for a long time very carefully is the insurance business. So Ji-Hoon, tell us more about your work looking at this insurance sector.
Yeah, thank you. So there is growing studies looking at climate change impact on the economy, including, for example, Elizabeth's study on looking at impact of climate change on health. So I'm gonna focus specifically on the impact of climate change on the insurance market and some challenges that the insurance market is facing to adapt to climate risk. So wildfire risk is escalating across the Western US in recent years. And the First Grade Foundation, which is a nonprofit organization researching climate impacts, estimated that about 4.6 million properties in California are at moderate to high risk of wildfires. So homeowners in those high-risk areas are more likely to experience wildfire damage. And so having property insurance is super important for them. So it can protect them from facing high financial losses when a wildfire event occurs. However, in California, those homeowners are facing some challenges when it comes to secure property insurance. This is because wildfire events are becoming more frequent and more severe. So a lot of insurance companies are thinking about reducing their exposure in high-risk areas. So they have been raising their premiums, and in some cases, they stop providing service in those risky areas. So this has posed a challenge to homeowners. So, so actually, property insurance can play a very important role in helping the insurance market adapting to these climate impacts. So, for example, it's important for those insurance companies to develop more sophisticated and more granular model for risk assessment. So by more accurately identifying risk, so they can price the risk of high welfare price the welfare risk in a more accurate way. So this can help them stabilize the insurance market in high-risk areas. So another way that insurance company can do is that they can actually help the homeowners to adapt, to invest more in climate resilience. So a recent report, climate resilience report produced by the U.S. Chamber of Commerce shows that $1 invested in preparation for a disaster can actually save $13 of economic cost and damage, like cleanup. So we know mitigation helps, but a lot of times homeowners, they don't invest in mitigation. So some reasons for that could be the high upfront cost, or there's a lack of information. For example, they don't know the probability of their homes could be damaged in the future by wildfires. And sometimes they don't know the private benefit of mitigation. And a lot of them don't have access to clear guidance of mitigation measures. So this is something that we can do to help them. For example, we can provide financial incentive or consulting service. We have them provide them information about their risk and like who to contact, the contractors, the information of the contractors. So this can help them reduce the annoyance of upgrading their homes to mitigate. So another thing is that there are more policies by California Department of Insurance to help the customers to protect them from that the insurers can dropping them from cancel their policies. So as researchers, we should more research are needed for looking at the impact of these policies on the insurance market.
Well, thank you very much. This, is very close to home since State Farm decided that they didn't want to insure my home for fire anymore. So we're looking for alternatives. Any suggestions are welcome. So, so talking about this, just I wanted to go back to kind of this, the risk assessment, Ben, and then we'll move to the, response from, this pilot project in California with Elizabeth. But the risk assessment, so what are these methodologies? Who developed them? I mean, how do firms, like, how do they, where are we in this, you're just saying it's mature in one way, but it's immature in another ways. Can you kind of develop a little bit what exactly this entails and whether corporations are doing the right thing?
Wow. How much time? Yeah. Yeah, look, well, I mean, I've been looking at this practice for a number of years. I mean, I previously worked in national laboratories, both here in Australia. It's historically, it's been a very scientifically driven process. And so the sort of standard model is, we have researchers who are working with global climate models that give you, simulate how the climate behaves in response to future changes in greenhouse gas emissions, as well as other drivers of the climate system. So they run these global models to produce projections of the future climate. Sometimes it's really coarse resolution. So they'll bring another set of models to get a higher resolution information. But you basically have a whole modeling community that continues to iterate and advance the science of projecting future climate change and extreme events We're getting now down to like 1 kilometer resolution modeling. So that tells you one piece of the information you need to know, which is what kind of climate or sea level rise situation am I going to have to face, 20, 30, 50 years down the road. Then the next spot is, okay, what's exposed to that kind of future climate? And often this is where I worked in, was now let's take a bunch of asset information, put it into a GIS system, bring in the climate information, and look at potential exposure. We're getting really, really good at that. Then the question, sort of, so what? Well, like, what is that asset actually that's exposed worth? How much have I invested in it? Who owns it? At what rate do I expect it to depreciate? How likely is it to be affected or damaged? You're getting into these sort of cost-benefit calculations around doing nothing with that particular asset or spending money to protect it or move it or do something different with that particular resource. So you've got this really sort of long knowledge value chain from what's happening with the global climate through to what do I, as an asset owner, what options are available to me, how do I feel about risk, and what decisions can I make? You have that whole long knowledge value chain you have to work through. And if you stop before you get to the end, then I would argue it becomes tough to make decision making, right? And so we're now at this point, and I'm looking at Stephen Torres, who knows this really, really well. I think the electrical utilities are sort of out in front of a lot of other industries in thinking about this, where they now sort of in-house have a lot of the capabilities needed to work through that whole analysis process. But as I'm sure Stephen will tell you, there's still some big uncertainties out there, compounded risks. What do we do about that? Climate models don't really just generate that information really in a straightforward way. Also, back to sort of Rosanna's points about, well, maybe we need to think differently about the problem to begin with. Maybe it's not just about assessing risk and building a seawall. Maybe it's thinking about a much broader array of response options that are more acceptable of change, or just thinking differently about the problem.
Yeah, well, thank you. I'm thinking from a kind of a regulatory perspective, kind of what are some of the incentives at this point for, for climate adaptation? And maybe, Elizabeth, you can talk a bit about this project. You were saying some pilots and some project that's where adaptation project that were put into place. If you could elaborate a little bit.
I'm not sure which one you're referring to, but we do have, we have a couple of projects that we're working on. And one thing I didn't mention when I was talking was we've developed and are continuing to develop something that's called our climate vulnerability matrix. And so that's looking at what areas of the state are vulnerable to climate change and using that to potentially feed into some of our incentive programs and be able to target those areas that are more vulnerable to climate change. Right now, one of the main things it looks at is heat and access to air conditioning and things like that. We also do have some research going on in terms of what you were talking about in terms of compound risk, like when you have a wildfire and you're also having excessive heat, what does that mean to people and who's most vulnerable there? And then how do we adaptation to that? What are some of the mitigation strategies that we could implement, or some of the adaptation strategies that we could implement that help protect people, but also help kind of, and I hate to use the word resilient, make more resilient communities, but that is something where it's like, it can be defined in many different ways. But as you're looking at how we adapt to climate change, trying to change more because it will create change. And how do you make that change? And how do you make it in such a way that the communities are more resilient to the impacts?
Mm-hmm. So, I mean, talking about the, kind of connection between the regulatory side and the risk assessment side, Ji-Yoon, you talked about the insurance companies that, need to be better at it. And if they're good at predicting the risk, then they can price, kind of the homeowner differently. But I think that in California, there is some kind of threshold. They can't actually price as much as they would like, which is one of the reasons. So what are some of these impediments that, you do have the information, but then you can't actually act on it? So what do you think of that?
Yeah, I think one thing is that you can help the customer, help your policyholders, help them invest more in climate resilience, because we know climate mitigation helps. So if you're there's a study showing that the impact of the building code regulation on the number of buildings that are damaged during a wildfire event. That research found that this regulation really has helped the homeowners, help them prevent their homes from being destroyed in a wildfire event. So if more customers invest in climate resilience, this can ultimately help them to deal with this challenge. So one thing you can do is that you can use behavior economics, use some financial incentives, or provide more consulting service like information, how to mitigate and who to contact, who to email, and help them to invest more in climate resilience, make more such decisions.
Yes. So I would like to open to questions, to kind of get the discussion going. I know we have some companies that have been doing here, Southern California, for Edison, for example, where they're doing climate risks assessments, or please, yeah.
It's just a general question.
Yes.
Good afternoon. Thank you very much.
Almost, yeah.
Almost good afternoon. It's a question about the insurance industries. Over the last 30 years, I've had a very close association with all the insurance companies, especially Lloyd's of London. Now, they're obviously carrying out immense studies on these topics. They've got amazing amounts of data. They're using AI to bring this all together. The underwriters, it's their lifeblood. To what extent do you actually liaise with Lloyd's of London to share data?
So is the question, to what extent do they share data?
Are you sharing data with organizations like Lloyd's of London, with the studies that you're doing?
Oh, yeah, our data is, publicly available on our website, so you can access it.
But are you sharing it with, are Lloyd's giving you data?
They don't know, but maybe, Jeanine, you can respond to that in terms of how much, did you get data from, kind of insurance? I know you're working on this.
Yeah, so this is still a research proposal, and I'm still not collecting data yet. So I'm not sure if I can answer this question.
So working on it, basically.
Yeah.
Well, I mean, just to jump in on this, I mean, it's a good point. So 20 plus years doing this kind of work on 2 different continents. I know of one example where a researcher was able to get any kind of data out of an insurance company. And they had to take the data and aggregate it a little bit. So there's some privacy issues around insurance data, which, are non-trivial. But there's also just proprietary and market. So they hold on to their data like it's money, because it is.
It is money, yeah. But it would be great if we could.
They got, to your point, they have wonderful data.
Just that my organization, we organized seminars actually in Lloyd's of London, actually on climate change. And there was a lot of sharing of data.
Okay.
Oh, nice.
Well, we'll have to
Get
talk
us an
more.
invite.
Okay. Yes.
Thanks. I do have a question it actually affects all 3 of your industries, but I'm very concerned about the state of California's push for density over environmental concerns. For those who know, you've heard about it. Example, Manhattan Beach about 9 years ago, was assessed 40 additional low-income homes to be built in the city, or residences. The last go around about 4 years ago or so was 700. So this is happening across all the cities throughout California, because the end of urban sprawl is occurring. No more are they encouraging developers to go outward. They want to put it into our cities. The direct impact on our coastal, areas, on our air, on the health benefits for humans, as well as the environment, are very concerning. And I love it if you could help explain to me the rationale for this.
Yeah, well, I live in Redondo Beach. My kids go to school in Manhattan Beach, so I get the vibe in the South Bay in particular around this. Generally the rationale is, one, you have the affordability issue of housing, which means you need to build more housing. LA historically has developed in a very sprawling way. The only way to sort of go back and address that is to rezone a lot of it to allow greater density. The question is, where do you allow greater density? That's often the big debate, but you got to have it somewhere. And more people and greater density on net can have greater environmental impacts. Obviously, that's why we're concerned about climate change in the first place. But comparing the environmental impacts of denser development versus sprawling development, it's sort of it doesn't compare. So what you want from an environmental protection standpoint is more people living in greater density as opposed to converting large amounts of new land, out in the high plains into housing. That leads to things like people spending hours in their cars, commuting into the city for work. That has problems in terms of air quality, quality of life, et cetera, et cetera. So the move toward more transit-oriented development, we see it here. We're decades late to the party, I think, compared to some other cities. But you can't neglect the issues around how do people feel about their community values, community amenity, people wanting to feel like the integrity of their community is maintained, and the idea of going to communities and saying, we're going to massively convert them to build more housing and change their character. That obviously raises a lot of people's concerns about what they value. So hence the ongoing debate.
Yeah, and I think, Elizabeth, you mentioned the disparity in how specific communities are exposed. Maybe you can expand on that.
Yeah, well, and I was just going to point out, kind of going off of what you were saying, one of the statistics I talked about, which is when you do have some of those denser communities, you have more options for transit, you have more options for walking, and those have huge health benefits as well, and air quality benefits, because you're reducing vehicle miles traveled, you're getting people to be more active. And I think the number I quoted was about 8,000 deaths that you avoid in that, or premature deaths that you avoid doing that. And obviously there are impacts on different types of communities, and making sure that those are done in an equitable way when you're looking at these sorts of policies. I can't speak to this specific policy, but those are some of the things we think about.
Yes, questions out there?
Professor Megali, you talked about the regulations earlier at the start. What do you think about readiness of companies to comply with, especially the California rule, which is happening next year? What do you think about readiness of companies to comply? I know you presented the top, the S&P 500, but there are a lot of smaller companies that gets in scope. And then what do you think needs to happen to facilitate compliance?
So that's a good question. I think that, looking at the S&P 500 gives us an idea of how the biggest, the most successful companies with the most resources do comply. And, we see that they are almost there, but, there's still some work to do. I think it's a huge undertaking for both the, Air Resources Board and the companies in terms of, we don't know exactly what is going to be required. We have some, kind of idea from what is happening in Europe and the standards that are developed, for the voluntary standards. But so there's still some uncertainty on exactly what is going to be required. But there's, no question that a lot of work will need to be done for companies to learn how to, evaluate the scope 1, scope 2, and especially scope 3. So a lot of the discussion is on scope 3. We actually are going to have a little workshop next week about, scope 3. How do you evaluate scope 3? Because there are so many different ways to do it and so many different categories of scope 3. So this is really work in progress. A lot of the companies are complaining that, it's going to be a lot of work that takes them away from doing the actual reductions. I think it's just a learning curve, so it's going to take a while for people to understand that. But if you don't know your footprint, it's going to be hard to make decisions on how to reduce it. So that's the first step. So I think it's a huge undertaking, and that's why I decided to teach a class on that subject at Anderson, because I think our students are going to be, will have to do that once they, they graduate, and that's all of us need to learn on all the sides. But
I think overall it's it's really a positive development. We need to know where we are, all of us. Yes.
Thank you. Mrs. Lee? Ms. Lee, just a question. You made mention to the fact that for every dollar spent on mitigation, it could save $13. If I'm misquoting you, please let me know. It could save $13 in the aftermath of a potential disaster. I was curious about what resources are currently available to businesses, homeowners, et cetera, to provide them with information on how they can spend that dollar as opposed to the 13.
Yeah, that's that number. That number is produced by the U.S. Chamber of Commerce. It's not actually specifically about welfare risk. It's about preparedness for a disaster in general. Yeah, so I think in terms of welfares, there are a lot of ways you can reduce your risk. For example, like your work on your building materials, cut the trees around your house. We have Mercury here. They have experts about on how to know how to deal with this. There are a lot of ways that homeowners can do to mitigate, and it's not. I think yeah. So the average cost may not be like more than $10,000. There are a lot of things you can do to reduce the risk.
Yes, question there.
Hi, I work in the multifamily space, and a lot of the conversation is around decarbonization, and hopefully that's making a dent. But especially in California, I think there's a lot of research around factory farming. Ben and Elizabeth, is there any research being done in your organizations and how that's impacting the state, like our water, our health?
Well, I'll start out. We just recently, probably about a month and a half ago, had a workshop talking about dairies, and it was focused on the air pollution side, but we had a lot of input from water boards. So we, as CARB, we work with all of the other state agencies, and farming and dairies in general is something that we think about and do research on what's being emitted, looking at from the air pollution side, more on the, looking at ammonia, looking at methane, looking at odors and things like that. And it's obviously something that's of a lot of concern to communities. I can say this workshop had and there's recordings of it online that I can provide. But while I was just talking about the animal population, there was a lot of communities that came to that and voiced their concerns across the board, which gives us stuff that we think about and we talk to with other agencies as well. So there's definitely ongoing research in that area that is coordinated with like CDFA, water boards, things like that.
You have a question? Yes.
I guess one of the changes one of the changes I'm following is the big influx of federal funding through IRA and IIJA, especially in the upcoming year. And I'm wondering how you see that affecting low-income communities and improving outcomes in the next year and beyond.
Good question. I think it's for Elizabeth.
I'll try to answer. If anybody else wants to jump in, it's a good question. I don't have specific information on that. I know that we have applied for and gotten some IRA funding, air districts as well. So for those of you that don't know, there are state agencies on air pollution that look at certain sources, and then we have quite a few, over 30 air districts as well, and they are looking at your stationary sources. So we have gotten money in on monitoring, working with communities, and some of that I believe is going into our 617 program, which it works with communities and with our air districts as well to improve outcomes there. I do know we have applied for some funding that looks at, and it's a recent, it's not specifically IRA, I don't think, but it's more on the methane emission reduction side, to get information on that and looking at remote sensing and specifically how we can get that information to communities, improve the information sharing, and and look at how we can make it more accessible as well. And that's just something we're overall looking at, is how can we make the research more accessible, understanding the health impacts and what that means to you, and kind of going back to like how that impacts behavior as well. Like if you have more information that's more accessible, then that can have an influence on what you do.
I'll follow up on that. Just obviously the Biden administration has sort of prioritized investing in disadvantaged communities, particularly under IRA and bipartisan infrastructure law. And that's all wrapped up in the Justice 40 initiative. What's going to be interesting to see is the sort of downstream evaluation of how successful were initiatives like Justice 40 or these kinds of geographic prioritizations of communities and actually driving money and resources into what have historically been disadvantaged communities. It's not going to be easy to tease out, I think. But there's a lot. So I think the way you're going to deal with that is like on a case study basis, where specific states, cities have examples where because of this funding package, we were able to do this thing that benefited these people. I think there's going to be lots of that kind of information, but the sort of big picture, being able to attribute economic development or certain types of projects and their economic benefits back to legislative interventions, I think is going to be hard.
That was a good question. So we're out of time. Thank you very much. And please join me to thank the panel. It's a great discussion.
So many thanks to our panel. Before you all leave, two announcements. One is our next forecast conference, first week in December, and it's going to be joint with the Robertson Lecture Series. And so our Dean, Tony Bernardo, and Mr. Jamie Montgomery are going to have a conversation that's going to be really interesting. We're going to be talking about finance post-election. So stay tuned for the information on that. And certainly we hope to see you then. And last, again, we're a public institution. We couldn't put on programs like this without the support of our sponsors. And I just want to thank them once again, our principal sponsors, RSM, Yamava Resort and Casino at San Manuel, Mercury Insurance, our platinum sponsors, law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, University Credit Union, at the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, Leap Development, PNC Bank, Robert Half and United Airlines. At the silver level, Bank of California, Chevron, Comerica Wealth Management, JLL, SoCal Gas, US Bank, Private Wealth Management, and Wilmington Trust. At the bronze level, Hanmi Bank, HDR, and Shawmut Design and Construction. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management, and Elphi Homes. Thank you so much to our sponsors enabling us to put on these programs. It's warm outside, stay cool, drive safe, and we'll see you all in December.